Good morning. This meeting will come to order. This is a public meeting of the Commodity Futures Trading Commission, and it is our last open meeting of the year 2020. I'd like to welcome members of the public and market participants, as well as those on the phone or watching our webcast. I'd also like to welcome my fellow commissioners, Commissioner Quintens, Commissioner Benham, Commissioner Stump, and Commissioner Berkovitz. As always, we'll begin with the Pledge of Allegiance. I'll lead, and anyone is welcome to join. So if everyone could unmute your mics. I pledge allegiance to the flag of the United States
of America,
to the republic for which it stands,
one nation,
under God, indivisible, with liberty
and justice for all.
Well, we originally had a very packed agenda for this meeting. In fact, we had 8 items in total that we sent out a public notice on. But the good news for all of you that are watching is that we were able to vote on many of these items via seriatim. Specifically, the Commission voted to approve the following matters. A final rule on swap execution facilities that focused on the audit trail, financial resources, and the Chief Compliance Officer requirements. We voted on a final rule for exemptions for the swap trade execution requirement. We voted to withdraw the unadopted proposals from the 2018 SEF proposed rule. We also voted on 2 final rules regarding margin requirements for uncleared swaps, one relating to the minimum transfer amount and another one relating to the material swap exposure definition and the initial margin calculation. And then finally, we voted on certain conforming changes to our regulations that conformed with our changes to our administrative structure here at the agency. So announcements on those votes with more information will be released shortly. However, today we're gathered because we're going to be discussing and voting on what I think are the 2 most important final rules to conclude the year 2020 with. For each matter, we will hear a staff presentation before the Commission deliberates and votes. We'll first have staff presentations and Commission deliberations relating to the final rules on risk principles for automated electronic trading. We'll then consider and vote on a final rule revising our bankruptcy regulations in Part 190. We'll now move to opening statements. I'll go first, followed by my fellow commissioners in order of seniority. Commissioners are free to reserve their time to make a longer closing statement if they'd wish. Well, this is the 20th open meeting of this commission of 5 commissioners we have had since I became chairman. That is more open meetings than the prior 7 years combined. So needless to say, we have been very busy. 12 of those meetings were held after the COVID pandemic started. And we just didn't have these open meetings to talk about the weather. When I was laying out my plan for this agency in the early days of my chairmanship, we focused on 5 key goals that have since been adopted by our commission. The first goal was to strengthen the resilience and integrity of our derivatives markets while fostering their vibrancy. The second goal is to regulate our markets, derivatives markets, to promote the interests of all Americans. Third, we want to encourage innovation and enhance the regulatory experience for market participants at home and abroad. Fourth, we want to be tough on those who break the rules. And finally, the CFTC wants to focus on our unique mission and improve our operational effectiveness. But a plan is only a piece of paper unless it's executed. Like Thomas Edison said, vision without execution is hallucination. The amazing thing is that this agency has advanced each of those 5 goals during the past year. In short, thanks to the incredible work of my fellow commissioners and CFTC staff, we've gone from goals to action. In fact, this agency this morning has approved 38 final rules. So my fingers are crossed because we have 2 more we're going to consider today that I guess would take us up to a even 40. That includes finishing all the major rulemakings to implement the Dodd-Frank Act and much more. Also, I want to specifically highlight and thank the men and women of the Enforcement Division for their incredibly hard work. For those of you that didn't see, we recently issued the annual enforcement report, and the CFTC had a record-breaking year in 2020. I'm immensely proud of their accomplishments, as well as their perseverance during the pandemic. Their efforts have made a real difference stopping fraud, and particularly where Americans were most vulnerable. This record-breaking year demonstrates the continued growth of our enforcement program, as well as the commitment and resolve of our staff. So just to provide a few of the highlights of that annual report, which again, I encourage all of you to read, we filed the most enforcement actions ever in the agency's 45-year history this past fiscal year, 113. So it was an increase over our previous high of 102 and significantly higher than our 30-year average of about 58. We collected more than $1.3 billion in monetary relief ordered, which is the fourth highest total in CFTC history, and the third year-over-year increase, the second straight year in excess of $1 billion. We also had our largest monetary relief ordered in any CFTC case in history, which was $920 million. We had more retail fraud actions filed in a single fiscal year, 56, in all of CFTC history, including a record number in the digital asset space, where we do see fraud and attempts at market manipulation in this nascent and growing field. We also filed a total of 16 actions with other federal criminal authorities, including the 3-year total of such actions was 46, and that's nearly double the prior 7 fiscal years combined. We also, for the first time, filed a state joint enforcement action with 30 state regulators and attorneys general, and that's been the most partners that the CFTC has ever had in any case in our history. So just an amazing job that our enforcement division has done. And I wanted to take the opportunity, since they're not normally talked about at open meetings where we consider rulemakings from the other divisions, I wanted to highlight their outstanding work. We've also been busy on the international front. One could say we hit the reset button on many of our relationships around the world. I've detailed those in other speeches, but the bottom line here is that I think we actually have created and built upon strong win-win relationships with jurisdictions such as the European Union, with the United Kingdom, and others around the world, and where the CFTC is also playing a much more prominent role in places like the Financial Stability Board and IOSCO. So really just an amazing job. Looking internally, I would say that despite the fact that we had a pandemic and many of the same problems that all of you in the public were facing, our own agency was facing. Our employees moved to telework overnight. Our technology team went into overdrive to make sure our systems can handle the change. And I'm really proud to say that this agency not only faced a crisis, but it thrived in the crisis. And once we settled into our new normal, we revamped some aspects of our organization so we can better serve the markets and the American people. In particular, we recently announced the reorganization of the agency, some additions to our executive team, and one of the most exciting changes is the creation of a new division of data. This division pulls together parts of the agency that take in and analyze all the market data we rely on to do our jobs. So again, let me just conclude by saying I'm so proud of this agency, my fellow commissioners, the staff, but we're not yet finished. Today, we're going to consider 2 additional rulemakings that will make important contributions to the efficient operation of our markets and market participants, risk principles for electronic trading, and also amendments to our bankruptcy regime. I'll reserve both of my comments, my comments on both of those items as we discuss them in turn. Thank you so very much, and I will now turn to Commissioner Quintens. Commissioner Quintens, you have the floor. Well, in light of potential technical difficulties, why don't I go ahead and turn to Commissioner Benham.
Good morning, Mr. Chairman. Can you hear me?
Loud and clear, and we can see you as
Great.
well, Commissioner Benham.
Thanks. Sorry for the glare in the background, but good morning to everyone. It's wonderful to be here, and I look forward to discussing these two important rules today. I think it's been a little bit of time since we've been together, so I'm glad to be here and interested to hear what the staff says. I do want to just comment and thank you for your brief remarks in the beginning. A lot of stuff that we've accomplished and a lot of work that we've done together in a unanimous fashion, which I think is just a testament to the work we do and the sort of collegial atmosphere that this agency has historically had, and that we continue to sort of work through and advocate despite the many challenges that we're facing. And I do want to point out, you mentioned at the very end the division of data, which I'm particularly excited about. I think it's a great concept that all of us have thought about and understand that in order to do our jobs and fulfill our mandate, we need a better understanding of the data that flows from our markets, through our markets, to the agency so we can surveil, assess, enforce in certain cases, but also just monitor for some risk across the board. So something that I think is a great starting point and can certainly be built on over time as we learn more about our capabilities and what we can do to better improve the market's transparency and integrity. So I'll end there. Looking forward to the discussion. Thanks again to you, Mr. Chairman, and I'll pass it back to you now. Thank you.
Thank you so very much, Commissioner Benham. We'll turn back to Commissioner Quinten. Okay, Commissioner Quintens is still having some technical issues with the interface, but we'll hear from him soon enough. For now, we'll go ahead and turn to Commissioner Stump.
Thank you, Mr. Chairman. Good morning. I'm very pleased to be here. I think you did a very nice job of summing up how busy we've been, not only over the course of the past year, but quite frankly, the past few weeks have been incredibly active. And so I wanted to just take a moment to talk about the past few weeks. And I think I would sum up the things we've done over the past few weeks as updating our rules for better markets, but with tremendous engagement and coordination from the industry that we regulate. And I think that's what sets the CFTC apart from perhaps other regulators, that we have that sort of unique relationship and coordination with the industry. And most specifically, I just wanted to mention that we're recognizing today that the effectiveness of the self-regulatory structure that Congress has established, and that requires day-to-day coordination with the trading facilities that oversee that self-regulatory structure. We're also, we've engaged in tremendous teamwork and public input to drive us to the point of updating our bankruptcy regulations for the first time in 37 years. There are a number of people who should be commended for assisting us in that effort. And I also wanted to mention the Global Markets Advisory Committee. Although we have now dispensed with the uncleared margin rules via seriatim and won't be considering them at today's meeting, I think that this highlights the particular benefit we as an agency, the value add that we receive from the Commission's ability to utilize our advisory committees as they advance recommendations to assist us in our policymaking efforts. And then notably, with regard to swap execution, the refinements that we've made to the swap execution facility rules have resulted from us listening and leveraging what we've observed over the past decade, and that too required an amazing amount of input from those who have utilized and established this entirely new market structure, entirely new regulated market structure for swap execution. So I just wanted to take the opportunity to not only thank those inside the agency who've worked on these efforts, but also those outside the agency who have really helped us enhance our regulatory updates and refinements. Thank you.
Thank you so much, Commissioner Stump. We'll go ahead and go to Commissioner Berkovitz before returning to Commissioner Quinten.
Thank you, Mr. Chairman. Okay, I think I've got my video and my audio on. Thank you, Mr. Chairman. I'm pleased to be here today, and I want to second the remarks that you've made, and Commissioner Benham and Commissioner Stump, certainly on the work that has gone into the rules that we are considering today and the ones that we've approved by seriatim. There's a tremendous amount of work that has gone into these, both within the agency and from the stakeholders interested in the CFTC. And I think, as Commissioner Stump noted, that's a testament to our collaborative nature, both internally and externally. And I'll have more to say, recognizing particular contributions in my final remarks, but I just, at this point, I do want to second the remarks that my colleagues have made so far. So I'm going to reserve some of my time for after the two rules that we're considering here, the debate, in order to recognize some of the work that's gone into them. I do want to note, as you indicated, Mr. Chairman, we've approved a number of items by seriatim rather than by public meeting. And I think public meetings and transparency are absolutely critical for the function of this agency. In these instances, given the nature of those rules, as well as just the overall press of business and the challenge of considering 8 rules or something in one public meeting, I think there's a risk of overloading the public on that and ensuring that each of these rules that we are considering in public, such as the two before us today, the bankruptcy rule and the risk principles rules, due to their significance, we really should be giving our undivided attention and full attention on those two rules in particular. So I've supported moving the other rules into seriatim. But in the interest of full transparency and accountability, I have written statements on each of those rules that will be up on our website. So at least in terms of my vote in support of those rules, that my reasons are set forth in the statement. They'll be on the web. So I think I've been supportive of accountability and transparency, regardless of whether we do these by seriatim or in public. So with that, I thank you, and I look forward to the discussion today.
Thank you very much, Commissioner Berkovitz. Let's see if we have Commissioner Quintens, and yes, we do.
Okay, can you hear me, Mr. Chairman?
I can indeed.
Okay, sorry about that. You'd think that after all of these 20 open meetings that we've had and a number through the pandemic and virtual environment, I would have figured this out by now, but I appreciate the immediate assistance I received, and nothing like turning off and turning back on to solve any technical challenges. Luckily, I think that's not what the exchanges do, and we've got some principles to talk about later there. So thanks for everyone's patience. But I would also like to join in echoing your and all of my colleagues' compliments to the staff for their hard work, not only on these rules today, and like Commissioner Berkovitz and the others, I'll have individuals to thank for their efforts there later. But Mr. Chairman, to you and your team for an incredibly productive and transparent tenure, for having 20 open meetings and hopefully finalizing at least 38, if not 40, rules in that process. Like others, I believe that having these open meetings not only is beneficial from a transparency perspective to add some discussion and color to the rules we're discussing, but we can each put out statements on rules that we don't do via seriatim. This gives us a chance to interact with other commissioners' thoughts, and I have such a great deal of respect for all of you, my colleagues, and your thinking and your rationale, that I value the opportunity to interact in this environment with those thoughts and critiques and suggestions. And I think it refines how each of us think, and hopefully it further supports the rationale for each of our votes beyond what would come out in a written statement that's stale and on the web. So I'd like to compliment you, Mr. Chairman. Sometimes, for those of us that might have more of a limited government philosophy, We might not think that having 20 open meetings to consider regulations would be positive. In this case, I unequivocally think that it has been. I think we have met the mission statement of the agency to promote the integrity, vibrancy, and resilience of the derivatives markets through sound regulation. I think as we look back on the rules that have been finalized, sound regulation, rationalized regulation that's calibrated appropriately to risk is exactly what we've achieved. So it's been a pleasure to be a part of it. Thank you.
Thank you very much, Commissioner Quintens. We'll now move to the first agenda item, which is the consideration of risk principles for electronic trading. After the presentation, the floor will be open for one round of questions and remarks from each commissioner. Following the close of discussion, the commission will vote on the rule. The final votes, conducted in this public meeting will be recorded votes. The results of the votes approving issuance of the rulemaking documents will be included with each document in the Federal Register. So to facilitate the preparation of the approved documents for publication in the Federal Register, I now ask the Commission to grant unanimous consent for the staff to make necessary technical corrections prior to submitting them to the Federal Register.
So moved.
Second.
Thank you. Without objection, so ordered. So at this time, it's my great pleasure to invite a combined staff presentation that will focus on the final rulemaking on electronic trading principles. So from our Division of Market Oversight, our Dorothy DeWitt, our Director, Marilee Dahlman, Special Counsel, Joseph Otchin, Attorney Advisor, Rachel Berdansky, Deputy Director, and David Steinberg, Associate Director. From the Office of the Chief Economist are Essen Onur and Eleni Gusgusnit. And from the Legal Division, we have Carlene Kim and Jeffrey Burns. And then finally, from our Division of Enforcement is Carlin Metzger. And from our Division of Market Participants is Greg Scopino. So a big host of people that worked on getting this final rule across the finish line for the Commission's consideration today. Dorothy and everyone else, the floor is yours.
Good morning, Mr. Chairman and Commissioners. Thank you for the opportunity to present today. My name is Dorothy DeWitt, and I'm the Director of the Division of Market Oversight, or DMO. Today, we present a final rule entitled Electronic Trading Risk Principles for consideration by the Commission. These risk principles reflect the CFTC's mission to promote integrity, resilience, and vibrancy of the U.S. derivatives markets through sound, principles-based regulation. They build on prior work by the Commission staff, and industry to ensure market integrity. In addition, they reflect industry feedback during the comment period for the rule. These risk principles are designed to ensure that moving forward, designated contract markets, or DCMs, continue to take reasonable measures to address the risk of market disruption as technology and markets evolve. I would like to thank the DMO team who led this project, Marilee Dahlman and Joe Ochin. The risk principles team, and it truly was an interdivisional team effort, also included our DMO colleagues, Jeanette Curtis, Bridget Wiles, David Steinberg, and Rachel Berdansky, as well as colleagues from multiple CFTC divisions and offices. That includes our colleagues from the Office of the Chief Economist, Essen Onur, and Eleni Gusgusnit, Carl Metzger from the Division of Enforcement, Greg Scopino from the Market Participants Division, and Jeff Burns from the Legal Division. We would like to thank them for their valuable contributions to this final rule. We would also like to thank the chairman, each of the commissioners, and their staff for their constructive comments, as well as we prepared the final rule. I'd like to especially thank Andrew Ridenour, Senior Counsel to the Chairman, for his contributions and stewardship of this rule, as well as others during the past year or more. These comments all serve to improve the risk principles we present here today. Before turning to the matter at hand, I would like to thank the whole Division of Market Oversight team. During the best of times, DMO oversees approximately 400 trillion notional derivatives, markets, identifying emerging risks and recommending policy to the Commission, and briefing the Commission and others throughout the government and industry about the market we oversee and any market structural changes. DMO also designates and examines exchanges trading our derivatives and reviews the products traded, among other things. As the first woman director of the Division of Market Oversight, I'm going to take a moment to borrow a quote from Ginger Rogers. And this was regarding her long career dancing with Fred Astaire. I did everything he did, but did it backwards and in heels. In this case, the entire DMO division did everything they normally did, but in this case, in the face of a COVID pandemic, working from home with all the challenges that may entail. And notwithstanding, they delivered and performed their job with excellence, with leadership, and with dedication worthy of our mission, our agency, and our country. The DMO team did not do this alone, and credit should be spread widely. They worked hand in hand with incredibly talented staff across the agency, and I'm truly proud of the team, the agency, and honored and humbled to have had the opportunity to lead DMO during this challenging year, 2020, as it comes to a close and we mark our last open meeting of the year. I do want to take a quick moment to give a special thanks to Vince McGonigal, Acting Director of Enforcement, for the contributions he has made to DMO and the agency as a whole since I joined last year. I'm now we'll now come back to the matter at hand, and I will turn it over to Mary Lee. We'll discuss the purposes of risk principle and summarize what they require.
Thank you, Dorothy. And thank you, Mr. Chairman and Commissioners, for the opportunity to present. Today, we present a final rule establishing a set of risk principles and related acceptable practices applicable to DCM for the purpose of preventing, detecting, and mitigating market disruptions or system anomalies associated with the entry of electronic orders and messages into DCM electronic trading platforms. Such market disruptions or anomalies originating at a market participant may negatively impact the proper functioning of a DCM trading platform by limiting the ability of other market participants to trade, engage in price discovery, or manage risk. The Commission, DCMs, and market participants all have an interest in the effective prevention, detection, and mitigation of market disruptions or system anomalies associated with electronic trading. As discussed in the Notice of Proposed Rulemaking for the Risk Principles, and as noted by several NPRM commenters, DCMs are addressing most, if not all, of the electronic trading risks currently presented to their trading platforms. The risk principles will require DCMs to continue monitoring these risks as they evolve along with the markets and make reasonable modifications as appropriate. The risk principles reflect a flexible approach that complements industry-led initiatives and previous Commission measures to address market disruption risks. The risk principles provide further regulatory clarity to market participants while preserving the DCM's ability to adapt to evolving technology and the market. The risk principles supplement existing DCM Core Principle 4 regulations in Part 38, namely Commission Regulations 38251 and 38255. The first risk principle, Regulation 38251E, requires each DCM to adopt rules governing participants subject to its jurisdiction to prevent, detect, and mitigate market disruptions or system anomalies associated with electronic trading. The second risk principle, 38251F, requires DCMs to implement adequate risk controls designed to address the potential threat of market disruptions or system anomalies associated with electronic trading. The third risk principle, 38251G, requires the DCM to promptly notify Commission staff of a significant market disruption to its electronic trading platform and provide timely information on the causes and remediation. In addition to the 3 risk principles codified in Regulations 38251E, F, and G, the final rules also include acceptable practices, the risk principles 1 and 2, which provide that a DCM can comply with these principles by adopting rules and subjecting all electronic orders to exchange-based pre-trade risk controls that are reasonably designed to prevent, detect, and mitigate market disruptions or system anomalies associated with electronic trading. The risk principles attempt to balance the need for flexibility in a rapidly changing technological landscape with the need for a clear regulatory requirement that DCMs establish rules governing electronic orders, as well as our market participants themselves, to prevent and mitigate market disruptions or system anomalies associated with electronic trading activities. I will note that the final rule makes only one change to regulation text that was proposed by the NPRM. In the NPRM, Risk Principle 3 referred to significant disruptions to a DCM's platform. Consistent with Risk Principles 1 and 2, which used the term market disruption, Risk Principle 3 was revised to add the word market. It now states that a DCM must promptly notify Commission staff of any significant market disruptions on its platform. This clarifies that the notification requirement in Risk Principle 3 applies to a subset of the market disruptions under Principles 1 and 2. As to Risk Principles 1 and 2, the preamble to the final rule clarifies that market disruption means an event originating with the market participants that disrupts the operation of the DCM or the ability of other market participants to trade, engage in price discovery, or manage risk. Market disruptions must materially impact the proper functioning of a DCM's trading platform and does not encompass disruptions that would only have a de minimis effect. All significant market disruptions under Risk Principle 3 also would be market disruptions under Risk Principles 1 and 2. However, the converse is not true. Some market disruptions under the first 2 risk principles will not be sufficiently significant to trigger the reporting requirement under Risk Principle 3. Thus, the standard for a significant market disruption under the notification requirement is higher than the standard for a market disruption under Risk Principles 1 and 2. I'll now turn it over to Joe, who will discuss the main issues addressed in the preamble to the final rule.
Thank you, Marilee. And thank you, Mr. Chairman and Commissioners. As Dorothy noted, we appreciate the industry feedback we received for this final rule. The comments are discussed in greater detail in the preamble, but we will address some of the main issues here. In the NPRM, the Commission proposed a principles-based approach to provide DCMs with the flexibility to impose the most efficient and effective rules and pre-trade risk controls for their market participants. Most commenters supported this approach. Some noted that it takes into account future technological advances and allows for differences between markets. In contrast, several commenters disagreed, asserting, among other things, that the regulations provided too much deference to DCMs. However, the final rule adopts the principles-based approach, supported by the majority of commenters. Consistent with that approach, the risk principles are enforceable regulations that provide appropriate flexibility for DCMs to adopt and implement measures reasonably designed to achieve the objectives of the risk principles. Some commenters also indicated potential overlap with existing regulations. As discussed in the preamble, the risk principles should be interpreted to supplement existing core principle 4 regulations to require prospective action to prevent and detect market disruptions or system anomalies in the context of electronic trading. As Marilee noted in her presentation, the risk principles supplement existing Commission regulations governing DCMs by directly addressing certain risks associated with electronic trading in DCM Core Principle 4 and its implementing regulations, namely Regulations 38.251 and 38.255. Regulation 38.251C requires DCMs to conduct real-time monitoring and resolve conditions that are disruptive to the market. Regulation 38.255 requires DCMs to establish and maintain risk control mechanisms to prevent and reduce the potential risk of price distortions and market disruptions, including market restrictions that pause or halt trading in market conditions prescribed by the DCM. The risk principles supplement these existing regulations by specifically requiring actions by DCMs to prevent, detect, and mitigate market disruptions or system anomalies associated with electronic trading. For example, excessive messaging that may materially limit participant access, and not only disruptions that involve trading halts or price distortions. In addition, Risk Principle 1 specifically requires the adoption of exchange-based rules, and Risk Principle 3 sets forth a new notification requirement for significant market disruptions. Finally, as previously noted, the acceptable practices to Risk Principles 1 and 2 provide that a DCM can comply with those principles by adopting rules and implementing risk controls that are reasonably designed. The preamble emphasizes that this is an objectively reasonable standard. Commission staff, as part of its oversight responsibility, would consider a DCM's measures in light of that market's product, volume, participants, and other factors, and how such measures compare to those adopted by similarly positioned DCMs to address similar risks. That concludes staff's presentation of the Risk Principles final rule, and we're happy to answer any of your questions.
Well, thank you very much, Dorothy, Marilee, and Joe, for an excellent presentation. To begin the Commission's discussion and consideration of these matters, I'll entertain a motion to approve the final rule on electronic trading risk principles.
So moved.
Second.
Thank you. I'd now like to open the floor for one round of Commissioner questions and statements in order of seniority. So I'll start. First of all, before I get into the substance, I just want to extend my thanks to DMO staff, in particular, you, Marilee, Joe, and Dorothy, but also David Steinberg, Rachel Berdansky, and others. Particularly, I want to thank you for your tireless work, not only in the last few months, but in the last few years. From the concept release to Reg AT to this summer's proposal to today's vote on the final rule. All of you have worked with stakeholders to develop a real understanding of electronic markets and how best to solve the novel issues by the move to those markets. This team in particular has been instrumental to the agency's evolution as we address this fundamental shift in our markets. I'd also like to thank our Office of the Chief Economist, Essen Honor, Eleni Gusgusnis, as well as Jeff Burns and Carlene Kim in the Legal Division, Greg Scopino in our Market Participants Division, and Carlton Metzger in the Division of Enforcement. This final rule and all the development that went into it has truly been a cross-functional team effort. that has raised the understanding of electronic markets across our agency. So thank you from the bottom of my heart, and I know many other fellow commissioners feel the same way. So on to the substance. I mean, I guess I spoke on this topic in June when we considered the proposal, and we're largely adopting the proposal as is. So I won't repeat much of what I have to say, but just in terms of the public to get a sense of kind of what we're doing here, I actually think in many ways this is a good problem to have, in the sense that if you think about one of the big lessons learned by the COVID pandemic, it was the fact that our markets could remain orderly and liquid and continue to run despite social distancing, in large part, and one could argue simply because of a but-for cause of electronic trading. If we had had the system that we had 30 years ago, and even sooner than that, with respect to open outcry trading in pips, for example, and then we imposed social distancing, our markets would have closed overnight. They would have not been able to remain open, and they would have not been orderly and liquid and allowed the American people and others around the world to hedge their risk in derivatives markets. So, big picture, electronic trading is a very good thing for our markets. More efficient, more effective, and certainly more resilient. However, of course, electronic trading comes with risk, and that's what today is all about. And this is an issue, as I mentioned, that the Commission has been thinking about now for several years. We haven't yet gotten anything over the finish line specifically on this topic, but it's really important that we do so, and it's important that we do so in a thoughtful way. And so, this is where the question of principles-based versus rules-based, how prescriptive should we be, really comes into play. And one of the things that I think this rule in particular acknowledged is because this area is changing so dramatically, that if we came out with something very specific, very detailed, the concern would be is that it would be obsolete overnight, potentially. And so by coming up with a set of principles, we allow market evolution and innovations to continue to keep up with, or our regulations to continue to keep up with the market's evolution. And therefore, we can always, as long as we are vigilant, can remain ahead of the curve. So I think it's really important, the principles-based approach here. A couple of questions I have are, number one, and I think, Joe, your presentation in particularly really honed in on this, is the fact that we have some stuff on the books that kind of deal with risk controls on one hand and maybe market disruptions and trading halts and things on the other hand, but we don't have anything specifically targeting market disruptions and system anomalies coming from electronic trading, and in particular, a directive to exchanges to create their own rules addressing this, as well as a notification requirement to us. Is that basically it? That in terms of supplementing it, there is this gap there, and it's important that we fill the gap.
Yes, Chairman.
Terrific. And then the only other question I have is we've had a very exciting year in the markets in terms of developments, but particularly volatility brought on by COVID-19 and other trends. And this has really put electronic trading to the test. Is there anything that we've seen throughout this year that would either urge you to maybe pause this rulemaking and say we need to think more about it because there may be stuff we've missed, or perhaps the opposite, saying it's more important than ever that we finalize this rule? So any sort of lessons learned, anything you saw during the volatility earlier in this year that would in any way impact this?
Chairman, I think, as you know, first, thank you for the question. The March sell-off reflected a turbulent time for our markets, for our derivatives markets, and for many types of commodities and for many contracts and sectors as a whole. We did observe rapid and large price changes in those markets, reflecting the uncertainty in the markets and some historic movement. However, the pipes worked well. There was high volatility, there was high message volume, There was high trading volume. We spent the better part of the first quarter and all of the second quarter of this year, speaking often on a daily basis with our exchanges and with our market participants in conjunction with my colleagues at the other divisions that oversee our registrants. And by and large, the pipes worked, the systems worked, they flowed. We identified, we asked our registrants to ensure that they were thinking about and looking at very carefully the controls that are reflected or the principles that are their risk and control frameworks in the framework of some of these principles. They did, and it reinforced our view that this risk principle rule is appropriate, is well designed, and is flexible enough to have legs and to have a long future that adapts with technology and manages the risks of human error and or malfunctions that could cause market disruption. So I hope that answers your question, Chairman.
Right. So I guess if I could sort of summarize it, essentially, we didn't necessarily see any major market disruptions or system anomalies from electronic trading, and certainly none that would cause us to reformulate these principles. But arguably, in the future, we may see enhanced volatility, continued risk. Should we see that in the future? Having these rules in place now, having the exchanges and market participants focused on them would be helpful.
That's exactly right, and well said.
Terrific. Well, I will issue a statement, I think outlining all of the reasons I'm supportive of these rules and voting for it, and I'll reserve that for later issuance. And with that, I will conclude my questions and turn to Commissioner Quintans.
Thank you very much, Mr. Chairman, and thank you to you, Dorothy, Marilee, Joe, David, and Rachel for your work on this final rule and on the proposal, and for working with me and my staff throughout the entire process. I think what I'd like to do is go through, some of my thinking and my statement, and ask a question or two, maybe in the middle where I get to a relevant part. I'm going to be supporting today's final rule, requiring DCMs to adopt rules that are reasonably designed to prevent, detect, and mitigate material market disruptions or system anomalies associated with electronic trading. This rule also requires DCMs to subject all electronic orders to pre-trade risk controls designed to address the risks posed by electronic trading. As I've noted previously, many, if not all, of the risks posed by electronic trading are already being effectively addressed through the market's incentive structure, including exchanges and firms' own self-interest, DCMs through their interest in operating markets with integrity, and firms through their interest in not exposing their or their clients' and customers' funds to large losses in a matter of minutes through algorithmic operational error. Both exchanges and firms have been leaders in implementing best practices around electronic trading risk controls. Therefore, today's final rule merely codifies principles underlying existing market practice of DCMs to have reasonable controls in place to mitigate electronic trading risks. Significantly, the rule puts forth a principles-based approach, allowing DCM trading and risk management controls to continue to evolve with the trading technology itself, like you described, Mr. Chairman. As we've witnessed over the past decade, risk controls are constantly being updated to improve and respond to market development. In my view, these continuous enhancements are made possible because exchanges and firms have the flexibility and the incentives to evolve and hold themselves to an ever higher set of standards, rather than being held to a set of prescriptive regulatory requirements, which can quickly become obsolete. By developing a principles-based approach, the final rule provides exchanges and market participants with that flexibility they need to continue innovating and evolving with technological development. As the preamble states very clearly, DCMs are best positioned to determine and implement the rules and risk controls most effective for their market. Under this rule, DCMs are required to adopt and implement rules and risk controls that are objectively reasonable. The Commission would monitor DCMs for compliance and take action if it determines that the DCM's rules and risk controls are objectively unreasonable. Importantly, the appendix to the final rule, as was described, points out that a DCM will be held to the standard of reasonableness and not to how other DCMs implement their own rules or risk controls. Which brings me to my question. And I don't know if, Marley, you would be the best or if someone else would be. But can someone please explain what kind of information or analysis you would expect the agency to take into account in reviewing DCM's rules and risk controls under that reasonableness standard?
Thank you, Commissioner. This is Joe. Under the risk principles, a DCM has discretion to determine what rules and risk controls are appropriate, but Commission staff, as part of its oversight responsibility, will consider the objective reasonableness of those measures in light of the DCM's product, volume, market participants, and other factors, and how a DCM's measures compare to those employed by similarly positioned DCMs to address similar risks. Staff recognizes there will be differences among DCMs, but the rules and risk controls one DCM implements to address the risk of material market disruptions may be relevant in assessing other DCMs' compliance. For example, if staff finds that a particular DCM is an outlier in terms of its rules or controls, that may cause staff to inquire further into whether there are legitimate reasons for those differences.
Thank you, Joe. I think that's very important that that any horizontal review across DCMs of rules or risk controls would only inform objectively unreasonable determinations and not create a baseline set of specific risk controls that become de facto regulatory requirements. And I think that it makes logical sense that in order to objectively determine if something is unreasonable, it helps for context, across the market, but not to create, de facto regulatory requirements that, we think one control works better and therefore, anything else would be unreasonable. I think that there's plenty of flexibility for exchanges to abide by these rules in a way that they think is most appropriate and reasonable. And there's also the legitimate opportunity for us as an agency to take into account the entire spectrum in deciding whether or not something is objectively unreasonable. The Technology Advisory Committee, which I'm very pleased to sponsor, has explored the risks posed by electronic trading at length. And in each of those discussions, it has become obvious that both DCMs and market participants take the risks of electronic trading very seriously and have expended enormous effort and resources to address those risks. For example, at one TAC meeting, we heard how the CME group has implemented trading and volatility controls that complement and in some cases exceed 8 recommendations published by the International Organization of Securities Commissions, IOSCO, regarding practices to manage volatility and preserve orderly trading. At a different TAC meeting, the FIA presented on current best practices for electronic trading risk controls. FIA reported that through its survey of exchanges, clearing firms, and trading firms, it found widespread adoption of market integrity risk controls since 2010, including price banding and exchange market halts. FIA also previewed some of the next generation controls and best practices currently being developed by exchanges and firms to further refine and improve electronic trading systems. The Intercontinental Exchange also presented on the risk controls ICE currently employs across all of its exchanges, noting how its implementation of controls was fully consistent with FIA's best practices. These presentations emphasize how critical it is for the Commission to adopt a principles-based approach, the one contained in this rule, that enables best practices to evolve over time. I believe the final rule issued today adopts that approach and provides DCMs with the flexibility to continue to improve their risk controls in response to technological and market advancements. Because this rule allows for flexible implementation and effectively places that burden on market participants with the most aligned interests and most motivated interests, I believe this rule will stand the test of time and serve as a paradigm of the CFTC's mission statement, sound regulation that promotes the integrity, resiliency, and vibrancy of the U.S. derivatives markets. Thank you, Mr. Chairman.
Thank you very much, Commissioner Quintens. Commissioner Benham.
Hello. Thanks, Mr. Chairman, and thank you first and foremost to the team, Dorothy, Joe, Marilee, and everyone else who's been a part of this process. Mr. Chairman, I appreciate your comments that this certainly does not just go back a few months. This goes back a number of years, as this particular rulemaking has taken on a number of iterations and certainly engagement with the public and the market to get it into the current condition. I do want to start with a few questions, and then I am going to read a statement. And I think, Dorothy, to your point, the rule has not changed much since we proposed it a few months ago. So if you don't mind, I do want to talk about two quick things. And I think, Joe, you may have mentioned this, but excuse me if it was Marilee, but the material versus de minimis market disruption, who's going to be the judge of that standard if there is a disruption at a DCM and within the context of having to report it to the Commission? What is that communication going to be like? Who are we going to be relying on to make those calls? And is there any sort of process that we're building into that decision making?
Sure.
Thank you for that.
Go ahead, Marilee.
Okay. Thank you for that question. I think first and foremost, we would say that reasonableness is an objective standard. And so while a DCM does have discretion to determine what rules and risk controls are appropriate, the Commission and Commission staff, as part of oversight responsibility, will consider the objective reasonableness of those measures in light of different factors, including the DCM's products and volume and market participants and other factors, and how effective those measures are. And when evaluating the effectiveness of those rules and controls, we would consider how a DCM's measures compare to those employed by similarly positioned DCMs to address similar risks. So while there might be differences among DCMs, what one DCM may implement in terms of rules or risk controls to address market disruptions may be relevant to assessing another DCM's compliance. For example, if the Commission were to find that one DCM was an outlier in terms of rules or controls, that might cause Commission staff to go ahead and inquire further about whether or not there's legitimate reasons for those differences.
Thanks, Marilee. And in terms of market events, and I think I understand your response in the sense of implementing a rule set to make a determination, it being objective. But in terms of market events, and I don't want to assume anything, but there may be anomalies, I assume, that happen at periodic times with the DCMs. To what extent are we going to be informed about these events within the context, these market events within the context of this rule? And that's where I'd like to get a better understanding, if it's possible, and it might be too premature at this point, but if a market event does occur, how are we going to be able to essentially know about it if we are relying on the DCM to make a call about what constitutes either de minimis or a material event such that it would need to be shared with us?
Hi, Mr. Commissioner, and thank you for that question. I can take this one. I think this is really similar in context to what we have in the system safeguards rules, in the sense that, we're saying it's a significant disruption, and what, the DCMs will have discretion in that. That's something that we certainly will look at in our oversight. It's also something, and you asked a little earlier about the process. We would expect it to be very similar to what we have in the system safeguards context, in that, we have a market interruption site. The DCMs know, they file notices, and we have a whole process. And I would expect this to work much the same way.
And this is Dorothy. I'm just going to mention that was Rachel Berdansky, Deputy for Compliance and Examinations. Thank you, Rachel, for those on the phone.
And then my final question is regarding, and I also appreciate, Dorothy, both your statements and the chairman's statements about the March-April period, where we had obviously extreme volatility and movement in our market. And I think we were all very pleased to see the outcomes writ large. Most importantly, that, the pipes, I think, taking a phrase from you, Dorothy, worked well. All things considered, from a historical context, for sure. But there have been a number of events since, and I think there were some comments, and if you could just either verify this for me or give me a sense of what you all at the division thought about with respect to potentially the WTI event in April. And then also, I do believe, and confirm this or not, that something like climate change, these outside market events, were going through a pandemic, which caused the March-April period, right? How do these events that we need to start thinking about and anticipating, how could these shock events start to affect our markets such that we need to build them into our sort of policy lens? And to the extent that you've thought about either of those, whether it's WTI or potential climate events in the future, how did that shape at all the rulemaking process?
Sure. Thank you, Commissioner, for an excellent question. I think there are very important elements that I'd like to break down in answering your question. Number one is that there are events, external events, some related to the market, some not. A health pandemic or climate change would be sort of exogenous forces, and there are sort of market-related forces that can cause events and crises. 2008 being the one that's been most studied over the past decade and informs us. This set of principles and this rule is designed to apply to events that are anticipated and events that are unanticipated equally. It's designed to enable exchanges and exchanges to identify what their risks are from human error and or malfunctioning systems, to design reasonable controls and reasonable risk control frameworks to address those that are reasonably designed to address those, and to allow for flexibility that is necessary to reflect what is a given, a known unknown, which is changes in technology, and those changes happen quickly and can be, happening, as an underlying platform during which a market event may, anticipated or unanticipated, may happen. So the rules were designed to anticipate exactly issues like the two that you just outlined. I do think that when it comes to April 20th WTI crude prices, which is, as those on the call and certainly the commissioners know, were outlined, the facts around which were outlined in a November 23rd published report entitled Trading in the NYMEX WTI Crude Oil Futures Contract leading up to, on, and around April 20, 2020. I think there's an important distinction to be made between this rule and some of the events that you described, including the events of April 20th in the WTI crude market. As I said in response to an earlier question, by and large and quite consistently, the pipes worked. They worked for the exchanges, for clearing, and for other types of registrants. Risk principles is designed to prevent material market disruptions or systems anomalies. And that might be human error or malfunctionings of systems. In other words, where the pipes don't work. And that might be a crack, it might be a leak, it might be degradation of the pipes, it might be a plug in the pipes, so on and so forth. And so risk principles is in some ways very different from what's outlined in the WTI crude report that we issued. In that case, the pipes did work. And in particular, I would go in to say that, using the analogy, the pipes work. So there are risks and controls that exchanges put in place. And insofar as those operate in the manner and way that they were intended and designed, then it's unrelated to these risk principles, what's trying to be achieved by these risk principles. And that's exactly what happened on April 20th. The exchange had designed circuit breakers, and those circuit breakers triggered 39 times that day. They'd also, the exchange also had designed velocity logic, like price, the speed at which prices change, algorithms, velocity logic algorithms. Those were introduced after the flash crash of 2010, and those worked exactly as designed. So I do understand the relevance of your question, both in terms of the scope and flexibility of the rule over time to operate well in unanticipated scenarios. But I do also want to emphasize that at least in one of the recent market events that you described, the WTI crude markets, the mechanisms of this rule are unrelated. The pipes worked in that situation.
Thanks, Dorothy. That's extremely helpful. And I think a couple things. One, certainly I understand that distinction, but I think it really, if nothing else, sort of manifests or it displays the differences in opinion that I have with you and the chairman about how to approach this. And as was pointed out by my colleagues earlier, a lot of what we're doing now is really nothing more than codifying what's already being done by the DCMs and the market, and they've been doing it for a number of years. So I think from a regulatory and policy perspective, it raises questions about, why are we doing this if it's being done and being done well? And if we're going to approach automated trading and electronic trading, how do we have to think about it from a policy perspective? And is this the right approach? And these events, which are, they're external events. I don't think anyone could have imagined 5 or 10 years ago that a health crisis, a health pandemic would have had such direct consequential effects on our financial markets for such a prolonged period of time. And I think as we start to think about these recurring external events, whether it's climate change or otherwise, we have to build into the reality that the economy and financial markets really underpin everything we do on a day-to-day basis. And whatever exogenous event may occur, it's going to have an effect on financial markets, both in the U.S. and overseas. So appreciate your point. I understand that distinction and your articulation was very nice and well taken. And I think it's important to understand that both for us, but also for the public writ large about really the differences that I think we have and the chairman has in terms of how we're going to approach this. So with that, I do want to thank you again. And I'm going to spend, Mr. Chairman, if you'd indulge me a few minutes in just reading my statement. And again, I'd like to start by thanking DMO staff for their tireless work on this rule. As I pointed out, while the risk principles are short, that is not reflective of the work that has been done by staff to produce them. This is the same DMO staff that worked on the much broader Reg AT, and I appreciate all of your work over many, many years. Last June, I stated in my dissent to the electronic trading risk principles proposal that I strongly support thoughtful and meaningful policy that addresses the ever-increasing use of automated systems in our markets. The proposal regarding electronic trading risk principles did not achieve this, in my view. Far from utilizing over a decade of experience that should have profoundly shaped how we address operational risks that are consistently unpredictable and have wide-ranging impacts, today's final rule changes only a single word from the proposal aimed at codifying the status quo. Accordingly, I have to respectfully dissent. A little over 10 years ago, as was pointed out by Dorothy, on May 6, 2010, the flash crash shook our markets. The prices of many U.S.-based equity products, including stock index futures, experienced an extraordinarily rapid decline and recovery. Following that, in 2012, Knight Capital, a securities trading firm, suffered losses of more than $460 million due to a trading software coding error. Other volatility events related to automated trading have followed with increasing regularity. In September and October of 2019, the euro-dollar futures market experienced a significant increase in messaging. According to reports, the volume of data generated by activity in euro-dollar futures increased tenfold. A lesson of these events is that under stress market conditions, automated execution of a large sell order can trigger extreme price movement, and the interplay between automated execution programs and algorithmic trading strategies can quickly result in disorderly markets. Recent events further amplify that in increasingly interconnected markets, which are informed by growing access to real-time data information, we do not always know how and where the next market stress event will materialize. This past April 20th, the May contract for the West Texas Intermediate Light Sweet Crude Oil Futures Contract, or WTI, on the New York Mercantile Exchange settled at a price of negative $37.63 per barrel. The May contract's April 20th negative settlement price was the first time the WTI contract traded at a negative price since being listed for trading 37 years ago. Technology glitches have continued to impact our markets. Just yesterday, a large retail broker that was significantly impacted by the events of April 20th suffered a significant failure in data storage. Recent technology glitches overseas have hampered our international colleagues as well, handcuffing markets for extended periods of time without clear explanation. In Japan this past September, the Tokyo Stock Exchange shut down for a day due to technical glitches in equities trading. And just last month, the Australia Stock Exchange lost an entire day of trading due to a software problem impacting trading of multiple securities in a single order. This discrete issue was enough to lead to inaccurate market data that necessitated shutting down the exchange for an entire trading day. As we consider today's final rule, there's a tendency to think that something is better than nothing and that today's risk principles, if nothing else, demonstrate the Commission's belief that mitigating automated trading risk is important. However, I continue to question whether these risk principles improve upon the status quo or even do anything of marginal substance relative to the status quo. The preamble seems to go to great lengths to make it clear that the Commission is not asking DCMs to do anything. The preamble states at the very outset that the Commission believes that DCMs are addressing most, if not all, of the electronic trading risks currently presented to their trading platforms. The preamble presents each of the three risk principles as new, but then goes on to describe all of the sections already taken by DCMs that meet the principles. If the appropriate structures are in place, and we have dutifully conducted our DCM rule enforcement reviews and have found neither deficiencies or areas for improvement, then is this exercise before us today anything more than creating a box that will automatically be checked? The only potentially new aspect of these risk principles is that the preamble suggests different application in the future as circumstances change. As I said in regard to the proposal, the Commission seems to want it both ways in many respects. We want to reassure DCMs that what they do now is enough, but at the same time, the new risk principles potentially provide a blank check for the Commission to apply them differently in the future. We do not know what the next external event to stress market conditions will be, but one likely possibility is climate change. In establishing new rules for automated trading, I would have liked the Commission to have taken a more fulsome look at both the events of April 20th, the COVID-19 pandemic more broadly, and the potential impacts of climate change on our automated markets. The recently published interim staff report on the events of April 20th provides a stark example of what can happen to automated markets under times of economic stress. The April 20th price plummet triggered both dynamic circuit breakers and velocity logic, exactly the type of risk controls discussed in the proposal that preceded the electronic trading risk principles proposal, commonly referred to as Reg AT. Reg AT was formally withdrawn at the chairman's discretion and without my support. Further troubling, it was withdrawn before the Commission staff had any meaningful opportunity to consider whether and how the risk controls in either Reg AT or the electronic trading risk principles as proposed performed during the trading around April 20th. There was arguably no better test case, and yet we charged forward without looking back. If the risk controls were effective, we should consider whether more specific controls along these lines should be part of the electronic trading risk principles in order to be certain that all DCMs are prepared to maintain orderly trading during such a confluence of events. If they are not, we should consider whether stronger risk controls are necessary. I also think that the risk principles would be improved if they were informed by consideration of the possible impacts of climate change, as I said. The preamble states, quote, "The principles-based approach provides DCMs with flexibility to address risks to markets as they evolve, including any idiosyncratic events. Referring to events such as climate change as idiosyncratic downplays their impact and places regulators and DCMs in a purely reactive posture. While we cannot know for certain what the next external event that causes stressed market conditions will be, that does not mean that we should remain idle until it hits, as we will continue to experience unanticipated and unprecedented events that will impact our markets and the larger U.S. economy. I'm concerned that a policy of simply checking a box will do nothing more than shield DCMs from public scrutiny and fault for the fallout. So often we hear that markets have evolved from a technological and innovative standpoint at an exponential rate as compared to their regulators. Rulemakings like this provide our greatest opportunity to proactively close that gap. We need to be proactive. Being proactive means studying the incidents of the past, like the flash crash, Night Capitol, and most recently April 20th, and the pandemic, so that we can recognize the precursors of events to come. Instead of just reacting, we can predict, prepare for, and possibly prevent the next crisis event. Again, while there is a temptation to advance this rule under the theory that something is better than nothing, in this case, I do not think that the final rules add much at all beyond the opportunity to take a victory lap. In other words, the theme in this case is that nothing is better than something. I believe that we can and should do better, and therefore I cannot support today's final rule. Again, thanks to the staff for all your work engaging with my staff over many, many months and years. But again, I think this is just a distinction and a difference in opinion about policy, how we should approach automated trading, electronic trading as it increasingly grows in our marketplace. And despite moving forward today and my no vote, I certainly look forward to working with all of you, DMO, and the other divisions in the future as we have to work through these issues over the course of many years to come. So thank you again, and Mr. Chairman, I'll send it back to you.
Thank you very much, Commissioner Benham. Commissioner Stump.
Thank you, Mr. Chairman. As has been discussed by others, I do not want our adoption of additional Commission-prescribed risk principles regarding electronic trading on DCMs to be taken as an indication that adequate attention has not been paid or that insufficient resources have not been invested by the exchanges to date to address the lessons that they've learned over the course of many years of experience with electronic trading as it's become more prevalent in these markets. But I also want to take the opportunity to stress the significance of something that's often overlooked in the direction that we received from Congress in Section 3 of the Commodity Exchange Act. Section 3A sets out Congress's finding that the transactions subject to the Commodity Exchange Act are affected with a national public interest. And then in Section 3B, Congress stated that it is the purpose of the Commodity Exchange Act to serve this public interest, and I quote, through a system of effective self-regulation of trading facilities, clearing systems, market participants, and market professionals under the oversight of the Commission, close quote. I support adopting these electronic trading principles as an appropriate exercise of the Commission's oversight that Congress expects from us, as stated in the Commodity Exchange Act. And while I do not question the exchange's diligence in addressing the risk in electronic trading on their platform today, I'm comfortable incorporating these principles into our existing rule set in order to make clear that DCMs must continue to monitor these risks as they evolve along with the market evolution and make reasonable modifications when appropriate. Importantly, though, I also support the principle-based approach of these final rules. This approach recognizes that the frontline responsibility for preventing, detecting, and mitigating material risks posed by electronic trading rests with the exchanges themselves. At the same time, this approach serves the public interest through a system of self-effectuating, effective self-regulation of trading facilities, just as Congress directed us in the Statement of Purpose of the Commodity Exchange Act. I do want to take the opportunity to just ask a few questions, but I would note that my colleagues have already asked a number of clarifying questions, and I just want to highlight a few related points contained in the adopting release for the public attention and interest. So I'll first begin with what types of situations these risk principles are intended to address, just to clarify and perhaps respond to any confusion that may exist, and I would call the attention of the public to page 32 of the voting draft. But my question is, am I correct that the risk principles are not intended to deal with intentional or reckless disruptive trading behavior, things like manipulation, spoofing, or prearranged trading? Rather, I think Dorothy pointed out the focus of these risk principles is on unintended technological malfunctions that disrupt the operation of the DCM or the ability of the market participants to trade or engage in price discovery or manage risk. So I just want to make certain that I read page 32 correctly.
Commissioner, this is Joe. What you stated was correct. There are, of course, provisions in the CEA and Commission regulations that address intentional or reckless acts of disruptive trading, but that's outside the scope of this rulemaking, which is focused on unintentional disruptions.
Thank you. And Joe, I think you've already mentioned this, but the release also makes clear that there's a materiality standard built into risk principles 1 and 2. In other words, the DCM's rules and risk controls must be reasonably designed to prevent, detect, and mitigate disruptions that are material impact the function of its trading platform. But then Mary Lee mentioned that risk principle 3 is distinct, and I note that it specifically uses the word significant. That is, the DCM must notify the Commission of any significant market disruptions on electronic trading platforms. Commissioner Benham spoke to this a bit, but for the members of the public listening today, can you please maybe restate and elaborate a bit on how the materiality standard in risk principles 1 and 2 relates to the word significant in risk principle 3?
Thanks for the question, Commissioner. So risk principles 1 and 2 use the term market disruption, and risk principle 3 uses the term significant market disruption with respect to the reporting requirement. So under risk principles 1 and 2, the rules and risk controls that the DCMs need to adopt to address the risk of market disruptions, there is a de minimis exception which is related to the reasonableness standard for compliance with the risk principles. So, a DCM could determine in its reasonable discretion that a disruption has only a de minimis effect, and then it wouldn't constitute a market disruption for purposes of the risk principles. With respect to risk principle 3 and the reporting requirement, as Rachel mentioned earlier, that it's analogous to the existing regulations with respect to system safeguards. So under existing regulations, a DCM must report to the Commission significant system safeguards incidents. And so similarly here, where it's a reporting requirement, the risk principle 3 regulation states that in the event of a market disruption that is also meets a significant threshold, that significant market disruption would need to be reported to the Commission. And so, again, I think that our view is that it would benefit both the Commission and the DCMs themselves that they don't have to report every conceivable market disruption under the first 2 risk principles, but that there is this added significance threshold with respect to what would be reported to the Commission, in a real-time or near real-time basis.
Great, thank you. I don't have any further questions. I do want to take the opportunity to call everyone's attention to the Commodity Exchange Act, and you guys, I think most people know, I always harken back to the statute when I have questions about where we should and should not be meandering. And I think that the Commodity Exchange Act makes it very clear that self-regulation is, in fact, a hallmark of our regulatory markets, and it's worked very well. Obviously, it requires oversight by the CFTC, and we want to ensure we're doing that in the most effective way possible. So I'm pleased to support today's rule because I do think it advances that approach, and I think it advances our obligations to continue to apply that approach. I want to thank the team. It has been pointed out that you all have worked on this for many, many years, long before I came to the Commission, and I appreciate the time you spent with my team helping us to get to the point we are today, and to Mary, Lee, Joe, Dorothy, and Rachel for answering all of our questions today. I very much appreciate it. So I'll turn it back to you, Mr. Chairman. Thank you.
Thank you very much, Commissioner Stump. Commissioner Berkowitz.
Thank you, Mr. Chairman, and thank you to my colleagues for a very interesting discussion. And I'd like to start off. I do have some questions for the staff, and first, I would like to thank the team, all the folks on the team, as well as the chairman's office and my colleagues for the work they put into this rule, and especially the team for working with my office on a number of specific comments on the proposed rule and clarifications. And it's been a very productive, collaborative relationship, and so I thank you for the work you've put into this. I'm going to be supporting the rule today. This is an area that we've needed to act for a long time. There's been extensive debate over this issue really for nearly a decade now. The flash crash in over a decade, in May of 2010, really is what prompted heightened focus. It was there even before the flash crash, but the flash crash really brought it back. And then there's some of the other incidents that have already been mentioned. Night Capital, there was another issue in the early 2010s that prompted the attention on automated trading and risk controls. And the Commission, forget the exact year, whether it was 2013 or 14 or 15, came up with Reg AT. I was disappointed that in consideration of this rule, we didn't adopt anything from Reg AT. I voted against the withdrawal of Reg AT. I think some of the elements in Reg AT were worthwhile, and that this rulemaking could have been informed, better informed by incorporating some of those elements in Reg AT. But elections have consequences, and the majority took a different route, and so we don't have any of those elements from Reg AT. Nonetheless, I think that something after a decade is better than nothing. And even Reg AT at its core, with its additional level of prescriptiveness, I wouldn't go so far as to say it was overly prescriptive, but it had an additional level of prescriptiveness in certain areas. But even Reg AT in its prescriptiveness, to a large extent, was reflective of industry best practices. It didn't go beyond industry best practices. It was reflective of industry best practices. So it's a question of how you do that, and some of the questions and issues we've been discussing this morning in terms of uniformity across exchanges, and how do you, from a regulator's perspective, incorporate industry best practices into a set of regulations so that you maintain best practices and you keep up with new events and new risks. These markets are not static. If we had a regulation that addressed the flash crash of 2010, if we had passed that in 2011 or 2012, maybe we would have learned something from the Night Capital that would have been different. We will learn something over the ensuing decade, and then we will learn something from WTI, and then we're going to learn something from climate risk. And each time one of these risks emerges, we can't pass a new regulation to address that new risk. We have to have regulations that are able to encompass new risks and that are somewhat stable and that evolve. At the same time, they have to give this agency the ability to enforce those regulations as those new risks emerge, and whether or not the industry and the exchanges and the market participants properly address those new risks. So we have to have both the certainty as well as the flexibility, because we can't just keep passing regulations. And frankly, the fact that it's been a decade after the flash crash and we still don't have a regulation, and that finally we're going to get one, I think attests to the problem with waiting till a perfect regulation to address it. So this regulation isn't perfect. I would have liked to see more from Reg AT in here, but I think it is a step forward, and I think it's an important step forward. And one of the things that I think is important about this regulation is it does give us the authority, based on the facts and circumstances, an objective reasonableness standard. If this commission concludes in the future that an exchange does not have reasonable risk controls according to an objective standard, we can take action. We don't necessarily need to pass a new regulation to address that risk. So that's the objective standard in this regulation, as well as the Commission's ultimate authority and responsibility to enforce that objective standard for these risk controls, to me, is a critical element here. And it's one reason why, despite the flexibility and as I said, some of those elements from Reg AT that are not here, I'm still able to support this rule. To a large extent, whether this approach is successful is going to depend upon the DCMs and the market participants to their commitment and thoroughness with which they implement it, and the thoroughness and comprehensiveness which they address new risks as they emerge. And for some of the reasons Quinten's has articulated, I think there is reason for optimism. The world has not been static while we've been debating this for 10 years. The exchanges have not been sitting by and say, well, what's the CFTC going to do on risk controls? We're not going to do anything, but so they do something. I think the market has really moved significantly in terms of, and there have been significant investments and significant improvements in the risk control. So we're not regulating against the static 2010, 2012 background here. The market really has moved forward, but this regulation, I think, has enforceability in terms of ensuring that they will continue to move forward. Now, Commissioner Benham, for example, has raised climate risks, and I want to commend Commissioner Benham for his excellent leadership on that issue, and that's definitely something that I think, and I agree with, that we should be looking at and looking into, and how our markets are designed to address that risk. I would suggest that we can do that and build upon this structure that we have today, if necessary, rather than wait another 2 to 3 years, perhaps, until we understand that completely and then are able to incorporate it. So I think both those objectives can be accomplished in this framework. Finally, if this doesn't work, if it is not working, if it is not adequate, we can always pass a new regulation. I hope that is not the case. I don't see this as the end of this road between us and the market in terms of how to get these risk controls in place. But I'd go back to what I said initially. It's been 10 years now since the flash crash. We've really got to make some progress. The debate will continue. The debate should continue. There are new risks all the time. We need to understand the WTI event. We need to understand climate risks. We've got to go forward. At the same time, we can't keep on continuing debating the flash crash. So I think this rule, while not perfect by any means, will enable us to make some progress on this issue. It gives us some authority, some significant authority, to ensure that the DCMs and the market participants are addressing the issue. And it preserves our flexibility for additional prescriptive or additional principles-based, or however we decide, or the future commission decides that it wants to approach this issue in the future. So for those reasons, I'm able to support today's rulemaking. And in that context, I think some of my questions that I had with respect to the materiality standard and the difference between materiality and significant have been asked and answered already. So I'll forego those questions and just ask, in terms of enforceability in this objective reasonable standard, is it correct that if we believe that an exchange's, the DCM's risk controls are not adequate according to what we believe is an objective reasonable standard, taking into account the circumstances, taking into account what other DCMs do, taking into account best practices, that we can take appropriate action under this authority to require DCM to impose such risk controls? Is that accurate under this regulation?
Yes, Commissioner Berkovitz. I'm going to turn it to Joe or Marilee, who will go into more detail on that.
Yes, thank you for that question, Commissioner. The Commission does have several tools in terms of ensuring compliance. First of all, whenever there's an application for designation as a contract market, if the Commission were to find that the applicant's rules were not reasonably designed to prevent and detect and mitigate market disruptions or system anomalies, the entity would not be in compliance with Core Principle 4, and the Commission would not issue a designation order. In another context, if a DCM were to certify rules or its controls as being in compliance with the Act or Commission regulations, the Commission can always object and deny certification or could stay the certification. In another situation, a DCM could request that the Commission approve a new rule or a rule amendment under Rule 40.5. And under that regulation, the Commission can only approve a new rule or rule amendment if it's not inconsistent with the Act or Commission regulations. Finally, a DMO rule enforcement review also could find that an exchange rule or risk control implemented to comply with this new 38251 is not reasonable. In that case, the examination could issue a deficiency finding that the DCM was not in compliance with the rule, and the deficiency could be referred to DOE. If the DOE were to take action, the Commission would have to approve that.
Can I ask you to just expand on that so maybe the viewers can appreciate? So we do these rule enforcement reviews where we directly review the various rules of the DCM. If we find that a DCM rule is not, let's say, for example, on risk controls, does not meet the objective standards, some new risk has emerged, for example, or we find some deficiency in their practice and in their risk controls under the objective standard, we do the rule enforcement review, and we typically in a rule enforcement review, we would present the findings to the DCM and ask them to correct it. We'd say, basically issue a finding, a material deficiency or something, and say, and work with them. And the first step we would take is to ask them or request or tell them to correct it. Is that rather than go to enforcement? Is that correct?
Yes, Commissioner Berkowitz. I'll ask if either Rachel Berdansky, who's the deputy who's in charge of compliance examinations, or Marilee would like to expound upon that. But the short answer is yes.
Yeah. Hi, this is Rachel Berdansky, and I can take that. So yes, if we were to find a deficiency, typically, we do work. I mean, the whole point behind examinations, it isn't an automatic one to send you to enforcement, is that, we really want to work with the exchanges to see corrective action. I mean, that's not to say if we saw a really significant violation or matter of noncompliance, I mean, depending on its facts and circumstances, a matter could get referred to enforcement. But the objective really is to work with the exchanges and bring them into compliance. I would also add is that, and I think Marilee touched on this in her earlier response to you, is that, Nancy Markowitz and her group rule review, and a lot of times we consult on that. We are looking at rules as they are certified. So if we identified a rule that we thought, was not, was inconsistent with the Act or the regs we had an issue with, we would certainly have some back and forth with the exchanges on that. So, I would hope that we would see it at that stage, but it's certainly something that we would review as part of a rule enforcement review.
Okay, thank you. I would note a number of years ago, one of the more effective use of rule enforcement review that I'm familiar with was with disruptive trading practices. I remember a number of years ago the Commission issued a rule enforcement review which found I think certain deficiencies in the prevention of disruptive trading practices, which that enforcement review really resulted in a significant upgrading of the disruptive trading practice prevention programs at TCM. So I think that was very, very effective in that regard. So these can be, and typically also the public doesn't necessarily see the rule enforcement reviews. These aren't these days they're not made public anymore, correct? So it's not a visible process. Unfortunately.
That is correct.
But the bottom line answer is if we find that a risk control is not adequate, there are mechanisms that we could use the authorities to address that.
Absolutely.
Yes.
Okay. So I think to conclude again, the rule is not a perfect rule. There are issues, there are emerging issues that have been discussed that definitely we need to understand, the market needs to understand, and that specific risk controls may need to be developed to address those issues. This can happen under this rule. I think this rule takes a step forward. I think we'll see how it's implemented, but I think it's a step forward, and therefore I'm going to be voting for the rule. So thank you, and thank you again to the team.
Thank you.
Thank you very much, Commissioner Berkovitz. And again, I want to thank the excellent staff from DMO for your great presentation. Thank you very much. The commissioners are welcome to get back on camera now to answer the following question. Are the commissioners prepared to vote?
Yes.
Yes. Fantastic. Okay, Mr. Kirkpatrick, our secretary, would you please call the roll for the motion on the final rule on electronic trading principles?
Thank you, Mr. Chairman. The motion now before the Commission is on the approval of the final rule on electronic trading risk principles. Commissioner Berkovitz.
Commissioner Berkovitz, aye.
Commissioner Berkovitz votes aye. Commissioner Stump.
Commissioner Stump votes aye.
Commissioner Stump votes aye. Commissioner Benham.
Commissioner Benham votes no.
Commissioner Benham votes no. Commissioner Quintens.
Commissioner Quintens votes aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Chairman Tarbert votes aye.
Chairman Tarbert votes aye. Mr. Chairman, on this matter, the ayes have 4, the noes have 1.
Thank you very much, Mr. Secretary. The ayes have it, and the motion on the issuance of the final rule on electronic risk principles is hereby approved. Well, thank you, everyone. We will now move to our final rulemaking item for today's open meeting, and that is the final rulemaking for Part 190, which governs the CFTC's bankruptcy regulations. From the Division of Clearing and Risk, we have Chief Counsel and Senior Advisor Bob Wasserman, who will present the final rule for our Commission's consideration. Bob, the floor is yours.
Thank you, Mr. Chairman. Can you hear me?
Loud and clear.
Excellent. Well, thank you, Mr. Chairman and Commissioners. To all of you and to all of you on this conference, my best wishes for good health for you and yours in these very trying times. Today, I am honored to present to the Commission a final rule amending comprehensively the Commission's Part 190 regulations governing bankruptcy proceedings for commodity brokers, that is, futures commission merchants and clearing organizations. The basic structure of Part 190 was proposed in 1981 and finalized in 1983. While a number of rulemakings have amended these regulations in light of specific issues or statutory changes, this is the first comprehensive revision of Part 190. Before going into the details of this presentation, it is meet and fitting to express appreciation for the many colleagues, both inside and outside the Commission, who have made this complex, detailed, and intricate final rule possible. First, I would like to thank my DCR colleagues, Ward Griffin, Jody Partridge, Abigail Knopf, and Eileen Schottner, who tirelessly worked extraordinary hours on drafting the preamble and on keeping me honest. I also want to thank my director, Clark Hutchison, for his calm and steady leadership. I would especially like to thank Mark Pfeiffer of the Legal Division for his trenchant and thoughtful criticisms, and also for invariably providing excellent suggestions on how to address those criticisms. I also appreciate the work of Scott Nixon, David Reifin, and Ayla Kahan of the Office of Chief Economist for very helpful criticism on the CBC. As I noted back in April, the Part 190 subcommittee of the ABA Business Law section submitted a set of model Part 190 rules that served as the foundation for the original proposal. These model rules, an impressive and meticulous piece of work, represented a consensus across a broad cross-section of interested parties, an extraordinary effort pro bono publico. When the Commission issued the proposal back in April, I noted how very important it would be for interested members of the public, in particular industry participants, to go closely over the proposal to find ways to improve it. I am deeply pleased to note that that call was well answered, and this final rule has benefited from a set of extraordinarily thoughtful, well-reasoned, detailed, and helpful public comments. Now, whenever we talk about commodity broker bankruptcies, it is important to put the issue in context. The FCM and DCO ecosystems are strong, given stringent FCM capital requirements, daily mark-to-market, continuous intraday risk management, active regulatory and self-regulatory supervision, and strict customer fund segregation requirements for FCMs, as well as tested and reviewed margin models, ongoing risk management, and strong default resources and recovery plans, as well as, again, strong regulatory supervision for DCOs. While we have had a literal handful of FCM bankruptcies over the past 37 years, no CFTC-regulated clearing organization has ever even come close to insolvency. The strength of those ecosystems was recently demonstrated during the unprecedented market volatility we saw this past spring, during which we had 0 FCM bankruptcies, 0 clearing member payment defaults of CFTC-registered DCOs, and only 1 clearing member, a non-FCM, that was liquidated quickly, efficiently, and in an orderly manner due to insufficient capital. Turning to today's revisions to Part 190, they can be summarized in 10 major themes. First, they add a new Section 190.00 that sets out the core concepts of Part 190. These rules of interpretation set out the Commission's intent regarding Part 190 in order to enhance the understanding of DCOs, FCMs, their customers, and the public at large, as well as, crucially, the understanding of bankruptcy trustees. Moreover, by setting these out after a notice and comment rulemaking, the Commission demonstrates that they are an authoritative statement of a fair and considered judgment that is well within the Commission's substantive expertise, consistent with Kaiser versus Wilkie. Many of these changes are designed to support one of the Commission's most important responsibilities, the protection of public customers and of the collateral they have posted. A third major theme is to foster the policy preference embodied in Section 764 of the Bankruptcy Code for transferring, rather than liquidating, positions of public customers in a proportionate share of the associated collateral. One of the most important changes we are making is from the case-by-case approach to clearing organization bankruptcy taken by the Commission in the 1980s to creating an explicit framework for the bankruptcy of a DCO. There was strong support among the commenters for creating this framework and for the majority of the elements in the proposed framework. There are some exceptions, and we will discuss those shortly. The fifth major theme is to note the applicability of Part 190 in the context of both the Securities Investors Protection Act for BDSCMs and in resolution under Title II of Dodd-Frank. A sixth major theme is to clarify that customers posting letters of credit as collateral are treated, in an economic sense, the same, no better and no worse, as customers who post other types of collateral. Another major theme is to clarify trustee discretion. Trustees must make decisions as to how to handle many thousands of customers with perhaps hundreds of thousands of commodity contracts in the days, in some cases the hours, after being appointed. Moreover, over the few FCM bankruptcies we have seen, each presents a unique set of circumstances and problems. As a matter of necessity, Part 190 permits the trustee to treat customers on an aggregate rather than a bespoke basis. On a related note, Part 190, following from Subchapter 4 of the Bankruptcy Code, favors efficiency and promptness over strict precision in order to foster prompt transfer and distribution of customer assets, and thus mitigates administrative costs. The eighth major theme is updating Part 190 in light of changes to the regulatory framework over the past 4 decades, or nearly 4 decades. Another major theme is recognizing changes to the technological ecosystem, including electronic records and communications, as well as digital assets. And the 10th and last theme is that revised Part 190 takes the opportunity to clarify language in existing regulations. As I noted before, we received numerous detailed and helpful public comments, and I'd like to share with you some examples of where those comments resulted in improvements to the final product that you are considering today. First, commenters expressed concerns about the discretion afforded to the trustee. How can we be sure that this discretion will be exercised to support the welfare of public customers? As a result, the final rule adds a new paragraph in 190.00 directing explicitly the trustee to exercise their discretion in a manner that they determine will best achieve the overarching goal of protecting public customers as a class, and to use, quote, reasonable efforts that are less than, quote, best efforts, only to the extent that doing so furthers that overarching goal. Similarly, we are clarifying that the implementation of DCO recovery and wind down plans should be not only to the extent reasonable and practicable, but also explicitly note that it needs to be consistent with the protection of customers. Another example is in the case of cash delivery property, where, following the comments, the final rule clarifies that cash delivered post-petition to pay for delivery constitutes cash delivery property, and that when a contract calls for the exchange of two fiat currencies, each of those currencies will constitute cash delivery property. In physical delivery property, the final rule addresses the potential for physical delivery where the settlement price is negative in light of some unusual events in the oil markets this past spring, and that too was addressed in the comments. Commenters provided a lot of support for ensuring that customers posting letters of credit were subjected to the same pro-rata treatment as customers posting other forms of collateral. But significant concerns were raised regarding certain delivery letters of credit in the context of an FCM bankruptcy. The final rule directs trustees to make sure that pro-rata treatment is achieved, but to do so in a manner that, to the extent practicable, mitigates the adverse effects on the customers posting those letters of credit. Moreover, and again consistent with a comment, the preamble confirms that delivery letters of credit where the FCM is not a beneficiary are not part of the FCM's estate and thus are not subject to these pro-rata distribution provisions. With respect to DCO bankruptcies, the final rule addresses the issue, raised by a number of commenters, of the application of Part 190 to registered DCOs based outside of the United States. It clarifies that Part 190 in these cases would apply only to a limited extent, just the technical provisions of Subpart A, the notice provisions, and to the positions and distribution of the funds of the public customers of SCM clearing members, thus achieving consistency between the U.S. bankruptcy and the foreign insolvency proceeding. The final rule clarifies, at the behest of a range of commenters, that a DCO skin in the game is part of customer property. It deletes the provision in the proposal that would have used the DCO's guarantee fund to plug any shortfalls in customer property for FCM clearing members' public customers, because of the concern raised in the comments that doing so might result in more onerous treatment for default fund contributions under bank capital rules. The final rule also addresses a number of technical matters raised in the comments, such as recodifying certain business as usual provisions into Part 1 of the Commission's regulations, revisions to Framework 2 to Appendix B to Part 190, addressing losses due to sovereign risk, the use of the term allowed in a manner consistent with other bankruptcy contexts, and how to deal with customer instructions concerning specifically identifiable property. I should also talk about a few areas where the final rule goes in a slightly different direction despite certain comments. The final rule modifies the requirement in the proposed definition of cash delivery property that the cash needs to be posted no earlier than 3 days before the delivery date, which is consistent with Part 190, current Part 190, that is. Some commenters wanted this limitation removed entirely, noting, among other things, that the 3-day period may be too short in the context of some holidays, including the interaction of U.S. and foreign holidays, or if FCMs required the cash to be posted sooner. However, while delivery property has protections in bankruptcy, it is not subject to segregation protections during business as usual. Accordingly, to protect customers and to avoid unintended consequences, the final rule takes a middle ground, extending the 3-day period to 7 days and thus addressing the problems identified. The question of additional customer collateral protection for delivery property remains under consideration, and if there are additional protections for delivery accounts enacted, it will be appropriate to revisit this aspect of Part 190. In the context of Subpart C, addressing DCO bankruptcies, a number of commenters objected to the use of uncalled assessments in determining the proprietary claims of clearing members. Our concern is that the assessment powers of DCO are part of a default waterfall that sets forth the basis for the allocation of default losses among all of the stakeholders. Clearing members know in advance the amount of assessments that they are exposed to. If we permit clearing members to benefit from the happenstance that certain assessments were not called before bankruptcy, it would necessarily be public customers that would suffer corresponding additional losses. That would violate the long-standing preference to protect public customers. However, in response to a comment, we did clarify that this applies only to the extent necessary to address defaults. We also had some comments that address issues relating to DCO default rules and recovery plans. First, some commenters wanted the Part 190 rules to reverse the effects of variation margin gains haircutting, both in FCM bankruptcies and in DCO bankruptcies. One key problem with doing so is that there is a limited amount of customer property available. That is, a pie of essentially fixed size. So, if you increase the claims of some customers and their share of the pie, you will necessarily decrease the distributions to other customers. The effect of this reallocation of the pie could be to reduce the distributions to some unfortunate customers below the amount of those customers' claims for initial margin, despite the fact that the FCM or the DCO was in full compliance with segregation requirements immediately before bankruptcy. I think it is fair to say that the industry has a very broad consensus opposing initial margin haircutting, and yet that would be the necessary effect of reversing variation margin haircutting. Second, some commenters opposed 190.15's deference to DCO's default rules and recovery plans. These concerns stem from objections to the governance of how those rules and plans are adopted and the level of input, from market participants exposed to mutualization of losses. However, disapplying these rules and plans in the unprecedented and exponentially unlikely context of DCO bankruptcy would do little to address the broader concerns these commenters have over that governance, since those rules and plans would be much more likely to be implemented, if ever they are, outside of DCO bankruptcy. Moreover, to the extent we create a regime where participants will be treated better if a DCO goes into bankruptcy than if it does not, we would be creating troubling incentives for those participants to grease the wheels towards DCO bankruptcy scenarios. Finally, as discussed above, we did add the qualification that applying recovery and wind-down plans must be consistent with the protection of customers. While Part 190 is not the appropriate place to address these concerns over the governance process by which DCO default rules and recovery plans are adopted, those concerns are very, very real, and I would submit very much need to be actively and thoughtfully considered. And I believe that staff will indeed be doing so in 2021. Finally, I would like to address the supplemental proposal. This proposal was made to address a potential problem that a SIDCO, a systemically important DCO, could file for bankruptcy before the so-called key turning process for Title II could be completed. That bankruptcy filing would, in turn, have the inevitable effect of terminating all of the SIDCO's contracts because of the SIDCO's closeout netting provisions. The supplemental proposed to address this problem by implementing a 2-day post-bankruptcy stay before those contracts could be closed out. However, to address the concerns raised in comments on the original proposal regarding the treatment of DCO rules as qualifying master netting agreements, or QMNAs, for purposes of bank capital regulation, the supplemental proposed to make the stay provision effective only if and when the prudential regulators made it consistent with QMNA status for SIDCO rules. It is fair to say that the commenters had significant concerns with the supplemental. First, many of them said that a bankruptcy filing before Title II key turning would be implausible, hard to imagine, or extraordinarily unlikely. While the premise that this problem is unlikely to occur is quite sound, unlikely is simply not enough, given the destructive effects on the U.S. financial system of terminating all of the CIDCO's derivatives contracts. However, the commenters also strongly urged that the use of a 2-day stay in bankruptcy would itself cause significant and unacceptable risks, even if the QM&A problem was avoided. Accordingly, this problem, which is very real, will nonetheless not be addressed through the use of a bankruptcy stay. Some of the commenters answered the Commission's call for a better way of achieving the goal by suggesting a requirement in Part 39 for requiring notice to the Commission before CIDCO's filing of a bankruptcy petition. Confidential advance notice does seem to be a very fruitful path to consider, in that it would achieve the goal without causing the problems identified by the commenters. However, in light of the concerns raised with the previous approaches to addressing this problem, it would very much seem the better part of wisdom to engage in further analysis and development before proposing this or any other alternative. This work, as well as the additional work I mentioned that we have to do in Part 39, are issues that we will be focused on in the near term. Part 190, along with Subchapter 4 of the Bankruptcy Code, have served our corner of the financial system very well. In almost all prior bankruptcy cases, they have helped public customers reliably to, within days, transfer their positions and regain control of most or all of their collateral. This has both helped to protect public customers and to enhance the reputation and thus the competitiveness of U.S. derivatives markets and clearing. Revised Part 190 builds on that strong foundation, implementing lessons learned, updating in light of changes over the past 4 decades, and taking many opportunities to make improvements. Mr. Chairman, Commissioners, we've come a long way, and thanks to the dedication and extraordinary efforts, both of folks within the Commission and of interested parts of the public, we have a comprehensively revised Part 190 that is well fit for its purpose. I thank you for your cooperation and help throughout, and for your attention today.
Well, thank you very much, Bob, for that excellent presentation and all of your work during these past few years. Thank you also, Clark, for your leadership of the division and your oversight of this critically important project. To begin the Commission's discussion and consideration of this rulemaking, I'll now entertain a motion to adopt the final rule.
So moved.
Second. Thank you. Well, I'll begin by offering my own remarks on this final rule, and the good news for everyone is that they'll be rather brief. When you're a first-year law student, you learn the concept of res ipsa loquitur, which basically means that thing speaks for itself. So I was thinking about, well, how do I convey how important updating our bankruptcy rules after 37 years are? And quite frankly, I don't think I have to, because the thing speaks for itself. Our bankruptcy regulations are absolutely critically important for both customer protection in an insolvency situation of a commodity broker, as well as promoting financial stability. So it's absolutely important and fundamental to sound regulation, which is part of our agency's mission statement, to ensure that our insolvency rules are up to date and reflect the current state of affairs. And of course, we've done that right today, and we'll do that as we vote for this final rule. I think you did a phenomenal job, Bob, of summarizing all of the aspects of the final rule, as well as ultimately what we decided to do with respect to the supplemental, which is at this point we'll stop where we are and potentially consider those issues down the line, which provide which do raise a number of interesting questions. But at this point, I don't think we need to get to those questions, because ultimately this proposal, I think, really brings up to date, again, after 37 years, where our regulations need to be. And in so doing, reduces systemic risk and also makes sure that our customers have the very latest in terms of protections. So I want to just commend you. I'll say a little bit about that a little later. But I do not have any questions at this time, and I know I'll benefit from the discussion and potential questions from my fellow commissioners. So with that, I will hand it over to Commissioner Quintens.
Thank you, Mr. Chairman, and thank you to both Clark and Bob for a lot of extraordinary work. And Bob, I would like to echo your thanks to the ABA for the product that they developed that informed and maybe inspired or motivated and created momentum for what we are hoping to finalize today. I just have two quick questions because I think this is a complicated topic, certainly for me, but I think for anyone that may be tuning in. And I think you did speak about these a little bit, but I just wanted to, give us another chance to highlight them. Could you provide a couple of maybe general examples of how this rule fosters the long-standing policy of promptly transferring the positions of public customers from a bankrupt FCM to an FCM that has not defaulted?
Yes, thank you, Commissioner. There are a couple of examples. So, for instance, in 190.00C4, we make that preference explicit. As well, the trustee is directed to use their best efforts to transfer all customer positions as soon as possible within 7 days in, I'm always forgetting whether it's 07 or 04. Additionally, in 190.07, consistent with 764 of the Bankruptcy Code, we protect both pre-relief and post-relief transfers from avoidance, that is, say, from avoidable preference actions. So that, in other words, that protects both transfers that were made before bankruptcy, but as well up to 7 calendar days after the bankruptcy. And finally, another example is in 190.07B3, we do provide some extra time to do account opening due diligence that would otherwise need to be on a different schedule for the accounts that are transferred, in other words, from the perspective of the transferee. Thank you.
Great, thanks so much for that. That's very helpful. I appreciate it. Last question. I note that the final rule acknowledges the applicability of the Commission's commodity broker bankruptcy regulations when an FCM is duly registered with the SEC and SIPA proceedings have begun. Can you explain how there would not be a conflict here between the Commission's regulations and SIPA?
Sure. So under the SIPA statute, the trustee is appointed not as part of the U.S. trustee system in bankruptcy, but rather by SIPC with the approval of a district judge. But that trustee has responsibilities for distributing not only securities customer property, but as well commodity customer property pursuant to subchapter 4 of the Bankruptcy Code, and that's there in SIPA. So what we have are securities customer claims that are addressed under SIPA and dealing with the funds that are segregated in what's known as the 33 account for securities customers. And commodity customers' claims are addressed under subchapter 4 in Part 190 through the futures account, the foreign futures account, the cleared swaps account, and delivery accounts. And so in other words, what we have are separate groups of property that are being distributed under these separate regimes. Now, I should note that in the unprecedented event that there is a shortfall on both the security side and the commodity side, both sides would be looking to the general estate to make up that shortfall. This has never happened, but there will be some rather interesting issues if ever it did.
Okay, thanks for that. And I recognize that a lot of the policy measures that we put in place here are looking towards the hypothetical, but hopefully not a reality. But they're important to put into place in the event that the hypothetical does become reality. But as you said, and I'd like to echo what you said, there's the resilience that we saw across the clearinghouse space during the extraordinary volatility and market moves during the March and April time period. And it's something for you and for our agency and for the market as a whole and the clearinghouse space to be very proud of. And that's all the questions I have. I have a statement that I'm going to release that goes through a number of the provisions that you highlighted and that I'd like to re-highlight. I won't read that now, but thank you for your hard work. I'm very pleased to support it today.
Thank you.
Thank you very much, Commissioner Quinn-Tens. Commissioner Benham.
Thanks, Mr. Chairman. And first off and foremost, thanks to Bob for all your work, your engagement, and your dedication to this over many, many years. You deserve all the praise that you've received so far and that in the future for really a dedication to this very important rule. Thanks to you, Clark, too, and the entire DCR team for leadership and commitment to this as well. Mr. Chairman, I'm just going to briefly read my statement. If you just take a few minutes for that. Some comments in here will address points that I think I've worked on with DCR over the course of these months. But by and large, I'm very pleased to support this important rule. The final rule is the product of years of staff analysis and engagement with market participants, including, as was mentioned, the Part 190 subcommittee of the Business Law section of the American Bar Association, which provided a detailed submission of suggested model Part 190 rules in response to a prior commission request for information. Several agency chairs going back many years deserve recognition and thanks for pushing to update Part 190 and starting this process and getting to us today where we are. Customer protections are at the heart of the Commodity Exchange Act, and it's imperative that the Commission have clear rules that direct how proceedings occur during a commodity broker bankruptcy. The revision is designed to recognize the many changes in our industry over the past 37 years, and most importantly, to inform of the Commission's experience with past bankruptcies, most recently the MF Global bankruptcy in 2011, which was the 8th largest corporate bankruptcy in American history. It gave Commission firsthand experience with what worked, what did not, and what could be improved. And that was my time when I first met Bob when I was working on the Hill, and I'd like to just make some comments about that time and engaging with him and my first exposure to Part 190. At the time, I was an advisor during the Senate's investigation of the MF Global bankruptcy, and during that investigation, I learned the intricate contours of Part 190, its relationship to the bankruptcy code, and how the larger puzzle of creditors, customers, and equity holders, among others, fit together. It was during those frenzied days that I truly appreciated the regulatory principle that customer margin is sacrosanct property. Because of my experience during those few months, I had made customer protections an absolute priority in my time as commissioner, and I know my colleagues feel the same way. Having spoken with many market participants at the time throughout that bankruptcy proceeding, including those whose money disappeared in the days immediately following, customer protection is the most pressing responsibility I believe we have as an agency. Just a few months later, in early 2012, the bankruptcy of Peregrine Financial Group, the catastrophic culmination of a fraudulent scheme by an FCM involving over $220 million in customer funds, further laid bare the strengths and weaknesses of the Commission's bankruptcy regime. Important lessons have been learned, both in terms of what works and what does not, and I believe today's final rule implements the lessons learned in both of those events and those that preceded them. Many of the changes to Part 190 in today's final rule further support provisions that have worked in prior bankruptcy. One of the themes of this refresh is clarity. The goal is to be as clear as possible about the Commission's intentions regarding Part 190 in order to enhance the understanding of DCOs, FCMs, their customers, trustees, and the public at large. Changes in this final rule will foster the long-standing and continuing policy for transferring, as opposed to liquidating, the positions of public customers, an important customer protection aimed at preserving the status quo and asset value. Other changes further support existing requirements, including the shortfalls in segregated property should be shored up from the FCM's general assets, and that public customers are favored over non-public customers. The new provision provide trustees with enhanced discretion based upon prior positive experience and codified practice adopted in past bankruptcies by requiring FCMs to notify the Commission of their intent to file for voluntary bankruptcy. Other changes address what has not worked or become outdated. In light of lessons learned from MF Global, the Commission is enacting changes to the treatment of letters of credit as collateral, both during business as usual and during bankruptcy, in order to ensure that customers who post letters of credit as collateral have the same proportional loss as customers who post other types of collateral. The final rule also addresses a number of changes that have naturally occurred in our market since the Part 190 finalization in 1983. The Commission is promulgating a new Subpart C to Part 190, specifically governing the bankruptcy of a clearing organization. As DCOs have grown in importance over time, including being deemed systemically important by the FSOC following the financial crisis, the Commission believes that it's imperative to have a clear plan in place for exactly how a DCO bankruptcy will be resolved. The final rule also addresses changes in technology over the past 37 years and the movement from paper-based to electronic-based means of communication, a lesson learned from the PFG bankruptcy. In many ways, this final rule is exactly how the rulemaking process should work. It looks retrospectively at major relevant events and applies important lessons learned regarding what works in the existing Part 90 rules and what does not, and what can be improved. But it also looks forward in a sense, recognizing changes in market structure and thinking ahead to the possibility of the bankruptcy of a clearing organization. This is a stark contrast to the risk principles final rule that we considered earlier today. And while the bankruptcy final rule looks back at the Commission's past experiences with MF Global and PFG and others, the risk principles final rule seems to ignore past events. While the bankruptcy final rule looks ahead and plans for the possibility of addressing a DCO bankruptcy, risk principles rule ignores future events such as I pointed out earlier, climate change. My only concern regarding the bankruptcy rule, and it is a relatively small one, is one of timing. The proposal for this rule was issued this past April. The comment period just closed on July 13th. And the Commission, as Mr. Wasserman pointed out, issued a supplemental notice of proposal during rulemaking in September. That comment period ended on October 26th. Particularly for a rule of this size and intricacy, the time that staff had to review and analyze the comment letters and draft the final rule and preamble has been incredibly short. Staff has worked tirelessly on this rule to get to the finish line. However, I think both the Commission and the public might well have benefited from more time for review and reflection before issuing such an important rule. But I think we're in a good place. I, again, commend staff for all their work, Bob for your work, Clark as well. And I think, as we always say within the Commission, and it was said earlier, we will continue to work on this over time on a daily basis, on a weekly basis, and we will continue to improve our policy as needed. On that note, again, I'd like to thank again staff for all their work in producing this refresh of Part 190 rules to provide important customer protections. Thank you, Bob. Thank you, Clark. And Mr. Chairman, I will send it back to you. Thank you.
Thank you very much, Commissioner Benham. Commissioner Stump.
Thank you, Mr. Chairman. Well, there's not much left to be said, but Mr. Wasserman is correct. We have come a long way in 37 years, and we didn't get here alone. And as I said at the beginning of the meeting, I've long believed that one of the attributes that distinguishes our agency and the industry that we regulate is the level of engagement and the spirit of cooperation between the derivatives market participants and the CFTC. As others have pointed out, the proposal to amend Part 190 of our regulations itself was the product of constructive external engagement with the ABA Derivatives and Futures Law Committee, and we do owe them a great debt of gratitude. And today's final rule, which accounts for the comments we received in response to that proposal, is an exemplary product of engagement and cooperation between the CFTC and our market stakeholders. Not only did we receive public input, but this final rule demonstrates how we carefully considered those views, and in response, I believe it is prudent that we are not finalizing the provision in the original proposal or the concept in the supplemental proposal that attempted to provide an opportunity for the FDIC, should it step in after a DCO has entered bankruptcy, to conduct an effective resolution of the DCO pursuant to Title II of the Dodd-Frank Act. I believe that any perceived problem in this regard and any contemplated solution requires further discussion among industry participants, the Commission, and perhaps even other regulators. The type of engagement that has benefited this rule thus far should also be sought as we contemplate how we proceed with that particular matter going forward. I do look forward to further engagement on the topic, and as always, I enjoy working with Bob, and I look forward to having further discussions with him in this matter. I do want to thank Bob and his team, everyone in DCR, for this amazing accomplishment. It is quite, for those of you who have not read it, I encourage you to do so. It will only take you a few minutes to understand how difficult the challenge of working in the Division of Clearing and Risk is on a daily basis. Quite technical and it's quite complex, and we have all benefited from their expertise. So with that, Mr. Chairman, I don't have any questions. I really just wanted to thank the team, not only for the many years they've spent on this rule, but for the manner in which they engage with the public in doing so. Thank you.
Thank you very much, Commissioner Stump. Commissioner Berkowitz.
Thank you, Mr. Chairman. I too would like to start off by commending the team, the DCR team on this rule, and particularly Bob Wasserman. I was at the commission when MF Global bankruptcy, and the weekend prior to the bankruptcy, I was working on our rulemakings, and Bob was there, the right hand of the chairman, in the discussions with MF Global leading into the prior to the bankruptcy. I think they didn't know necessarily, that the following bankruptcy would occur, but trying to take measures to preserve as many assets as possible prior to the bankruptcy in the event of bankruptcy. And when the bankruptcy occurred that Monday morning, very early Monday morning, we deputized Bob right away to represent the agency. I think Bob went right up to New York and was really right there with the trustee in the court, representing the commission, and not just when I say representing the commission, really representing the customers, and our involvement, the agency's involvement, and Bob's involvement was really critical to customers getting as much recovery as possible. And this agency's role in ensuring customers' recovery is really integral. And that was a really important public service that we did, Bob did at the time. And if we're ever called on another bankruptcies, our role is going to be extremely critical in there too. The bankruptcy code, as you can see by this rule, it's somewhat challenging to actually implement it, because it's something you hope is never implemented. You can count, on one hand the number of bankruptcies, and it's incredibly complex. So from a practitioner's standpoint, it's incredibly challenging, because you really have to know the intricacies of the code and the regulation. The on-point person, as Bob was, say, in MF Global, for example, you get 2 days. You're in court. The judge is asking you, and the trustee is asking you, can I do this? Can I transfer that? There's a lot of money at stake, and you have to know the answers right off the top of your head for something that occurs in once, every 5, 7, 10 years, if in good circumstances. Hopefully it doesn't occur more often than that. So it's difficult enough maintaining a proficiency in the law, but to maintain a proficiency in this code that is never used is even more challenging. And I commend Bob and the team on this, and I think I just want to also say that I'm thinking about it, and presents a challenge for this agency in terms of the depth of our bench and our ability to support this type of activity, because our role in these bankruptcies is absolutely critical in the distribution and the maximization of customer assets. So I think we have to think about that to ensure that we have the continuity and the depth to be able to handle one or multiple of these in the unfortunate event should they occur. The other thing that I think those of you who would either be blessed or cursed with reading this rule in its entirety, the rules, CFTC rules and Federal Register notices are typically dry. They're in the third Federal Register government speak. I think our rules have been actually all written. They're very clear. We do a good job making it clear and simple. It's unusual, though, that there's any voice in any of these rules. And I think if bankruptcy rule, Bob's voice comes through clearly in setting it up and how the agency responded to comments and considered the comments. And I think that will live on in your voice will live on in the Code of Federal Regulations at the Federal Register, more the Federal Register than the CFR. But let me ask you in that regard, in terms of comments, the bankruptcy is necessarily, there's a shortfall of assets to liabilities. So in many cases, there's going to be less than 100% recovery. We try to maximize recovery. And many of the comments we received, and we received many good comments, many of the comments were received was like, and I think this is fundamental to the approach that we're taking, is we want to get as much recovered as possible quickly, to get customer assets recovered quickly, and that has resulted in greater discretion for the trustee. I think some of the themes in the comments were you're basically telling us trust the trustee for everything will work out. The trustee has the charge, maximize distribution quickly, and I think there were some reservations or some that's it. Are we just trusting the trustee to do a good job? So could you respond? How do we respond to that comment that we're just turning this over to this trustee and telling them, do what's reasonable under the circumstances?
Sure. No, I think, look, why do we need this discretion in the first place? And I think some of the things that you have talked about in your remarks, dealing with the very different circumstances of, happily, as I've mentioned, we've only had literally a handful of FCM bankruptcies over the course of the decades. But we've had very different circumstances in REFCO, where the entity actually was fully capitalized, not only fully segregated and fully capitalized. In Lehman, where happily we had all of the funds in segregation, but as folks know, there were problems elsewhere in Lehman that required the sale. To MF Global, where we were able to do a transfer, but uniquely at the time, there was a shortfall. And then, of course, in Peregrine, where there was that massive fraud that meant that, in fact, transfer was not possible, although the trustee there has been doing a very good job over the years in getting funds out. So we have all of these unique circumstances. There are some very strong guidelines, though, as to what the trustee needs to do in terms of ultimately the calculations. But in the details, there is the need to handle these bespoke situations. And remember, the most important time is literally the hours after the bankruptcy, when we try, and in most cases have succeeded in getting to transfer as much as possible of the customer positions, so we don't have roil the markets and hurt the customers by having this mass liquidation. We get to transfer the customer positions and transfer as much as possible of the customer collateral. Having the trustee have the discretion to figure out how best to do things is really the only thing that makes that practicable. And so, in other words, we could be very meticulous and say, you need to do things in this way, and then in this way, and then in this way. And every customer would be treated in a meticulous and precise manner. And within, 5 years, no more than 10, they'd get all their money back. There is that tension, right? If you deal with things on a very precise manner, then everyone is treated very precisely, but it takes a long time. And oh, by the way, it costs a lot of money to do so. I mean, one figure that sticks out in my head is that in the Lehman bankruptcy proceeding as a whole, they had $5 billion in administrative costs. This sort of approach tends to mitigate the administrative costs, because the trustee is basically doing things rather than spending lots of time, profitable, billable time, asking permission as to exactly how to do things. And so that's really the reason why we favor the discretion. I will say, in my experience working with trustees over the years, they have been extraordinarily dedicated to doing their job the right way and to getting as much as possible out to public customers. And as a result of the comments, we've added in a number of places, most particularly in 190.00C, a very explicit provision making that, elucidly clear that the goal, that in exercising discretion, the trustee needs to exercise that with the goal of looking after the interests of the public customers as a whole, right, as a group. And there were some concerns about reasonable efforts versus best efforts, making clear that in doing something less than best efforts, it should only be in aid of achieving that overarching goal of looking after the interests of the public customers. I hope that helps.
Yeah, that is very helpful as to the necessity for this discretion. In terms of the other players, so to speak, in terms of the CFTC or the court, is there oversight or input to the trustee? How does the CFTC or the court the trustee?
So in actually, making distributions, that is supervised by the court. The CFTC, both by 762, gives us the right to appear and be heard on any matter within such a bankruptcy. In fact, my experience has been the trustees work very, very closely with us. Look, the trustee does not want to be in a position where they're coming in and saying to the court, you should do X, and the CFTC comes in and say, well, we've got some problems with that. Essentially, as a matter of practicality, the trustee and the CFTC work hand in hand in terms of trying to make things work and in terms of trying to get to the right outcome.
Yeah, that was my recollection from the MF Global situation, where you were reporting back on what the trustee was proposing, and that they were working very closely with him, and he wanted to make sure he had, if not even though he may have had the authority, he wanted that CFTC stamp of approval on it as
yes,
to say
yes,
the proper thing.
Absolutely.
So that should provide. It's not. He's just some additional support for the trustee's discretion to do the right thing under the circumstances. So turning to a similar issue, one the other context that the rules for the first time is create a regulatory scheme for DCO bankruptcies. Again, we got comments regarding Section 190.15, which directs the trustee to, within reasonable discretion, follow the debtor's DCO recovery and wind down plans. And so we got comments on that regarding the extent to which the trustee should follow the DCO recovery and wind down plans, and how that might relate to customer recovery. Could you explain how we responded to that comment, what we did in response to the reliance on the DCO recovery and wind down plan?
Sure. So, I think it's fair to say that there have been some concerns raised about how DCO default rules and how their recovery and wind down plans are designed, and the governance process around that. And those concerns have been raised by a bunch of folks from among the clearing members and among some of the larger buy-side firms. And as I mentioned, this is an issue that we really do need to address. But for various reasons, as I mentioned, I think we need to address those outside of Part 190. Because to the extent folks are concerned about the recovery and wind down plans, those are designed and intended and frankly, I think expected to prevent bankruptcy. And so the concerns that folks have with those plans could not be addressed, other than to a small extent by addressing them in Part 190. And again, the other concern is we don't want folks feeling like, if we get this into bankruptcy, then we get where we want to be, because that creates some very, very bad incentives. But on the other hand, as you mentioned, yes, there is a concern, yes, but if we do get this into Part 190, we want to make sure that the trustee, in implementing the recovery plans, which I should note are not necessarily public, and parts of them will most likely not be, how can we be sure that the trustee, in implementing them, is doing so consistent with the interest of customers? And so whereas the proposal had said that the trustee should implement those recovery and wind down plans to the extent reasonable and practicable, we added explicitly a modifier and consistent with the protection of customers, to make it clear that, look, that is the goal here, right? And once we're in bankruptcy, the top priority here is to protect the interests of customers. And so we added that to the rule, from the as a change from the proposal into the final rule to make that explicitly clear.
So does that mean you would not necessarily follow the plan if it's inconsistent with customer recovery?
Yeah, or you would essentially, the trustee would modify it. And again, the idea always has been, right, we put in to the extent reasonable and practicable in the first instance because it might not be, translate perfectly. But this says, yes, and another reason to modify the plan and to diverge from what the plan says is because you need to make sure that what you're doing is consistent with the protection of customers.
Okay. Thank you. And as you noted, and I would agree, the recovery and wind down, that's an issue that we need to continue to address, and there's been dialogue going on it, and we need to continue that dialogue and address concerns. There's a lot of concerns that need to be addressed, and it's not a simple challenge, but we need to face it. That's our job. So I would support continued work in that area in coming time. So thank you again, Bob and team, on this rule. I'm very pleased to be able to support the rule, and it's after 37 years to comprehensively do this is really significant achievement to modernize it. So thank you for your efforts in this regard.
Thank you.
Thank you very much, Commissioner Berkovitz. So I think at this point, we can have all of the commissioners who'd like to appear. I want to thank Bob for your outstanding work again, which in many ways represents a culmination of your career at the CFTC, and also Clark for your leadership on this issue. Are the commissioners prepared to vote? Okay. Yeah. May I please ask Mr. Kirkpatrick, our dutiful secretary, to please call the roll for the vote to adopt the final rule revising the bankruptcy regulations in Part 190.
Thank you, Mr. Chairman. The matter now before the Commission is on the adoption of the final rule revising the bankruptcy regulations in Part 190. Commissioner Berkovitz.
Commissioner Berkovitz votes aye.
Commissioner Berkovitz votes aye. Commissioner Stump.
Commissioner Stump votes aye.
Commissioner Stump votes aye. Commissioner Benham.
Commissioner Benham votes aye.
Commissioner Benham votes aye. Commissioner Quintens.
Commissioner Quintens votes aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Chairman Tarbert votes aye.
Chairman Tarbert votes aye. Mr. Chairman, on this matter, the ayes have 5, the noes have 0.
Thank you very much, Mr. Secretary. I'm pleased to say that the ayes have it, and the motion to adopt the final rule revising the Part 190 bankruptcy regulations is hereby approved. Well, now that we have approved our final bankruptcy rule and concluded both of our rulemakings for today and for the year, I'd like to make a statement, which I think the other commissioners will share, about it's in connection with Part 190. And many of my fellow commissioners, as well as those in DCR, raised this issue. And it's that I would like to recognize, on behalf of the agency, the Part 190 subcommittee of the Business Law section of the American Bar Association, representing a broad cross-section of interested parties and stakeholders, and co-chaired by Vincent Lazar of Jenner & Block and Catherine Trickla of Foley & Lardner. And I believe both Vincent and Catherine are here with us today, so please feel free to appear. You guys have led, and all of the other members of the committee, an extraordinary pro bono effort that ultimately culminated in the submission to our commission of a model Part 190 proposal. It was a comprehensive amendment of the current regulation, and it really served as the foundation of the rulemaking that we ultimately voted on today. So, Vincent and Catherine, on behalf of the Commission, I am honored to present to the Part 190 Committee the Chairman's Award for Regulatory Excellence, and it should appear on the screen, a picture of it, and I appreciate you being here, Vincent and Catherine, to accept this award on behalf of the Part 190 Committee. And this is just a great example, again, as many other commissioners echoed throughout this meeting, how important it is for our agency to work with market participants, with the American public as a whole, and stakeholders here in the United States and around the world to make our regulations better. So it's an honor for me to bestow this award on you today. And again, I think it's a great example of win-win. Well, I don't think there is any other business for today's meeting, so I would like to now move on and give my fellow commissioners an opportunity to make any potential closing statements. We'll do it in reverse seniority order. That means I will start with Commissioner Berkovitz.
Thank you again, Mr. Chairman. At this point, I would like to recognize the hard work of everybody at the agency, as well as the public commenters for all the rulemakings we've done this year, and recognize also the work of everyone in the agency for all the other work that we have done this year. We've accomplished a lot this year in 2020 under very challenging circumstances. And to a certain extent, I wish more people were aware of what we do. I think if folks looking at the CFTC and certainly our community, I hope, realizes and understands and watching us that our political system and our government isn't completely broken, that Washington, D.C. is not all gridlock and personal attack, that people of different backgrounds and philosophies can come together through debate and sometimes consensus and sometimes disagreement towards what is in the public interest. The CFTC was set up with as a five-person agency for diverse viewpoints, to bring a diversity of viewpoints to the matters of great importance regarding the stability of our derivative and commodity markets. And it's through that interaction of those diverse viewpoints that the overall public interest comes out. As I said, sometimes we agree, sometimes disagree, but I think the real winner in that process is the American public. We have the strongest capital and risk management markets in the world, and a large degree of the success of those markets is due to the confidence and integrity of those markets. Why do people invest money in our markets? They believe that either capital will appreciate, they can discover prices, or they can manage their risk. And it's not going to be taken away by fraud or cheating, and that it's safe and secure, and that our systems are safe and secure. And that is proven time and time again. And yes, there are instances where not everything works perfectly, and we work to correct those. I'm very proud of the work that we've done at the agency in the past year towards maintaining and improving the integrity of our markets. And all the people of the CFTC, I know in my time at the agency, are absolutely dedicated to that. And I think that's shown particularly in this time of COVID and working remotely, where people are making sacrifices daily, adjusting challenges of working at home, tending to families, at the same time having a very demanding work schedule. Today, we've appropriately recognized rulemaking teams and those who have appeared before us, but there's a whole number of a whole organization supporting those teams and those rulemakings. And I just want to, I can't obviously to identify everybody in the agency would be not time for that, so I'm going to have to be somewhat abbreviated. And a couple offices I want to name in particular, and one is the Office of General Counsel. Knowing from personal experience what the rulemaking schedule and the accomplishments, Mr. Chairman, that you listed out over this year, I can attest firsthand to the amount of work that the legal office puts in to supporting an agenda like that, to support this rulemaking agenda, to support the enforcement agenda, to support the administrative work of the agency, to ensure that our interactions with the public are according to statute. That's a tremendous amount of work. The Office of General Counsel, I guess the legal division now, doesn't always appear in front in public, but I certainly appreciate all the work they've done. They've done a great job in supporting the rulemakings, supporting enforcement actions, and done a great job in the litigation facing the agency. The Division of Administration has really kept this agency running throughout this year. They've helped us secure the budgetary resources, the personnel resources, and keep our computers running. And it's something we take for granted a lot, and we get upset if we've got a 5-second delay in some of our emails or whatever. But just like the markets have worked well under these remote conditions, so has our agency. I remember I think it was March 11th, we were told March 12th is going to be a test day. Everybody, stay at home and log in from home to see if the system can handle everybody logging in remotely at the same time. And so we were home on March 12th remotely, or wherever we were working remotely, and it worked. And it did work. and from then on, we've been in the situation where we have been working remotely, and now we have this video. It's not optimal. It's not as good as being in person. I miss the office. I miss the personal interaction. I think there's something lost from doing it remotely. But those are the circumstances we're in, and we're all making the best of it. And there's been tremendous dedication and commitment to making the best of it. And I'm so proud of the agency and everybody in it. And again, there's many others working very hard to make all this happen. I'd like to thank each and one of my fellow commissioners. I came to the commission having knowing at that time the chairman, Chris Giancarlo, and Dawn and Russ, having known each of you for many years, and it was a great something I was really looking forward to after working in various other capacities with each of you coming onto the commission and working with you. And it has been just a great experience, lived up to all my expectations. So I want to thank you for that. I didn't know, Mr. Chairman, you or Commissioner Quintens prior to coming on, but after serving with you for a year or 2 years, I can really call you friends. We've agreed, we've disagreed, we've worked together in the public interest. I've enjoyed the dialogue, the give and take, and I think the outcome has been to the benefit of the American public. So I now have several new friends on the commission and strengthened my old friendships. Finally, I'd like to thank my office, Lucy Hines, Eric Remler, Sebastian Peugeot, and my administrative assistant, LaTanya Williams. We were all working. We were emailing, working late Friday, Saturday, and into the evenings, Friday evening, Saturday evening, Sunday evening, to get all our comments considered, working with the staff who was working at those same hours, working on the statements that are up on the website. And that's true commitment and dedication. Working at home on the weekends in early December, as they have done on so many weekends throughout the year. And that's one of the things, I come to the agency and you want to make a contribution to public policy. But one of the great treasures of working in a place like this is not just the contributions to public policy, but the great friendships and relationships that get built along the way. And that's really one of the great parts of this journey that we're all on, is building those friendships. And I certainly really, my office and the support and the friendship and the professionalism of my staff and their commitment to this agency and the public interest is really outstanding. And that's those relationships I will also treasure. So I've gone at some length, but I think it's appropriate at this time where we are in the year, looking back on the accomplishments in the holiday season, as well as a recognition of the challenges placed upon us by the pandemic. We're certainly not out of the woods yet, but this agency, I'm very proud of the way we've met those challenges, and we'll continue to do so. So thank you, Mr. Chairman, and I look forward to whatever's next.
Thank you very much, Commissioner Berkovitz. Commissioner Stump.
Thank you, Mr. Chairman. And while I don't think I could say it any better than Commissioner Berkovitz, 2020 certainly was not the year we all had anticipated. Global health pandemic, civil unrest, extreme market volatility. But as we approach the holiday season, I do think that it is worthwhile to reflect on some of our favorite things. Yes, that is a song, Rodgers and Hammerstein song, but don't worry, I'm not going to sing, and I'm not going to talk about roses or kittens and whiskers or anything like that. I want to talk about my favorite things at our agency. And in 2020, I think that it's worth noting, as Mr. Berkovitz pointed out, that our agency has performed extremely well under tremendous stress, and that the industry we regulate has also continued to innovate in the midst of a crisis, which is going to be extremely important as we move forward with economic recovery. And to ensure that those efforts were not in vain, our robust enforcement program continued to ensure that those who jeopardize the integrity of our markets were held accountable. But my absolute favorite thing about the CFTC is that even though my commission colleagues may sometimes differ in our opinions or in the way we approach our jobs, we stayed the course to refine and update the regulations that ensure that they remain fit for purpose. And I think we built upon the progress that those who came before us have made, and I know that going forward we will continue to refine those rules and continue to ensure that the markets that we regulate are serving their intended function. So with that, I wish everyone happy holidays, and I'm hopeful that 2021 won't be quite as eventful as 2020, but I know that we're all up for the challenge, and I appreciate that I get to do it with the four of you and a tremendous team at the CFTC, including my own personal staff that has, as Commissioner Berkovitz pointed out, has worked almost every weekend, I think, all year. And I really do appreciate their time and their energy and their attitude. So thank you, Mr. Chairman.
Thank you very much, Commissioner Stump. Commissioner Benham.
Thanks, Mr. Chairman. And I would support a motion to sing holiday songs if Commissioner Stump insisted. So there's certainly that to end this interesting year. There's really not much to add to what Commissioner Berkovitz and Stump said, echoing everything they said about the agency, our relationship with each other at the commission level, all the amazing work that the divisions have done given the challenges of this year. But I think we're all looking forward to some time to reflect and be with our families in the next few weeks, and hopefully start the new year off on a better foot with a lot to look forward to in 2021. So I just want to thank all of them, Commissioner Berkovitz, Stump, Quintens, and yourself, Mr. Chairman, for your friendships and working with each of you. I know, as Commissioner Berkovitz pointed out, we do differ on a number of policy issues, but as I've said to many people, this is the beauty of commissions, of bipartisan commissions, being able to learn from each other, understand each other's points of view, and ultimately use the friction of our differences to come out with better results, better end products that support the markets that we care very deeply about. And Mr. Chairman, thanks for your leadership during this particular year. It's been a very exciting and busy year and a half since you took over at this point, and I think we've done a lot, and I think above all else, I've appreciated your transparency in laying out your agenda. Although busy, and I think that's good for all of us, given what we're going through, I think, in our personal lives and at the workplace, having a sense of what's to come is extremely important. Having that certainty in our calendar and what policies you support just makes things easier. So I thank you for that. And I'm going to just end with thanking my staff, David Gillers, my chief of staff, Laura Gardy, and John Dunphy, who all did an amazing amount of work leading up to today on a number of issues that were not necessarily discussed this morning, but we did a lot of work to get to where we are today with a number of actions, Mr. Chairman, that you pointed out at the beginning of the meeting. Special thanks to John for the bankruptcy and the risk principles matters that we discussed today. And as I reflect on 2020 and think about my staff, we've all been through a lot, good things and bad things, both personal and professional, but we've stuck it out together. We've worked together. We've supported each other, and we've picked up where others, have been busy or have not the best expertise, and we've done a number of things. And I think it's a testament to teamwork, and also I think the collegiality and the teamwork that the entire agency displays on a daily basis. So a special thanks to them, and I do wish everyone a happy holiday as we end the year and look forward to a brighter 2021 and many things to look forward to. So thank you, Mr. Chairman, and I'll send it back to you.
Thank you very much, Commissioner Benham. Commissioner Quinten.
Thank you, Mr. Chairman. Those are tough acts to follow. I would just like to acknowledge, reciprocate all of the prior commissioners' sentiments around how wonderful it is to work with them on issues of concern to the market, issues of concern to the public and to the government. And while we can agree or while we can disagree, we have an underlying amount of respect for each other. And as I think all of them said, I certainly consider them friends more than colleagues. And it's just a privilege to work at an agency where you can interact with such intellectual firepower, in some cases in opposition to your own views, and consider those people close friends, during and certainly after those discussions. 2020 certainly has been a year of the unpredictable, I think, as was described before. But as was also described, we have the most resilient, deepest, most liquid risk hedging markets in the world. And these markets were designed for the unexpected. These markets were designed to handle the mitigation of known risks and unknown risks. And I think we've seen that borne out. And I think we've seen it borne out because the market, to a large degree, relies on the innovative spirit of entrepreneurialism and of capitalism with the appropriate, reasonable regulatory framework to ensure that everyone is meeting their obligations for fraud and for abuse, and to ensure that we have the information we need that these markets operate efficiently and effectively when any one firm may not necessarily have that incentive on their own. And so it's important that we continue to embrace, rationalize, well thought out, calibrated regulations like I think we have done, Mr. Chairman, under your tenure and certainly here today. And I'd like to thank you for all of your work, your diligence, that of your team and that of the agency in seeing this through, and certainly that of my own. For the past two meetings, I've had the opportunity to thank and wish good luck and goodbye, maybe not goodbye, but until next time, to two of my former staffers. I get the opportunity to do that today, again, with Peter Calls, who joined my staff from DCR. And Peter is just an incredibly dedicated and hardworking, incisive lawyer and member of this agency. He's provided an enormous amount of insight and background and analysis of highly complicated topics, including the bankruptcy rule we consider today, as well as many other clearing matters and commission precedents with which I was not familiar or had any background in before coming to the commission. And in addition, for the past few weeks, as I said, Peter's been, my lone staffer. And for anyone who knows how many items come through a commissioner's office for review and opinion, you'd know that Peter has been handling a huge number of diverse items, and sometimes with deadlines that don't correspond to their complexity or priority. So in short, I'd just like to say I wouldn't have been able to do this job without Peter. And I'm thrilled that the American public, our markets, and this agency will continue to receive the benefit of his expertise in the future. And with that, Mr. Chairman, I wish you and all my colleagues and everyone watching a happy holidays and a happy new year. Thank you.
Well, thank you very much, Commissioner Quintens, and all of the commissioners. The great thing about going last is that this may be my easiest closing statement ever, because I can simply associate myself with all the great things that my fellow commissioners have just said. And I truly agree. All the points they raised, I couldn't agree with more. I also want to thank everyone here at the CFTC, not only my fellow commissioners, but their staffs as well. Their staffs have worked incredibly hard this year alongside the agency staff, all of our divisions, all of our offices, from the Division of Administration to the Legal Division to the Policy-Making Division. Everyone has really made 2020 an important year. And quite frankly, I think in decades from now, people looking back, when they think about what happened during the past 12 months, about the historic volatility wrought by COVID, not only in the markets, but also in our agency, how we responded and worked extra to ensure our markets remained orderly and liquid, and how we achieved at the same time a historic rulemaking agenda and record-breaking enforcement. I think people may very well look back at 2020 and say this was among the finest hours of the CFTC. So it's a tremendous privilege to be the chair of this agency. I want to thank everyone for having attended this meeting today. There being no further business, I would entertain now a motion to adjourn the meeting.
So moved.
Second. Thank you. I mean, it was such a great meeting. I could see you wanting to prolong it, but we will speak again. Those in favor of adjourning the meeting will say aye.
Aye.
Those opposed, no. The ayes have it. I am truly grateful again to the CFTC staff for their great work. I want to wish everyone a happy holiday season and, of course, best wishes for 2021. This meeting is hereby adjourned. Thank you.